And you can come to grief because that person doesn't have the right temperament. Now, what is the temperament? The temperament is, don't look at your regulated universe as a bunch of crooks. If you start with that assumption that everyone in that universe that you regulate is a crook, then you won't make any progress. My preferred philosophy has been, it's nothing original, it's an old philosophy, but something that I subscribe to, trust but verify. Don't go on the path of distrust and crucify, which is occasionally what happens. Some cases you're fixing a small problem, you kill the institution. So you throw out the baby with the bathwater. And the regulatory space has any number of examples of that. Just look at the number of institutions that closed down in the United States in 2008. Some of them had problems of liquidity. They were treated as problems of solvency, and the door was shut on them. If somebody had the sense to sit back, take a deep breath and say, this is a problem of liquidity, we can fix this. This is not a problem of solvency which needs to be dealt with differently, you wouldn't have had so many shutdowns even in the United States. So the temperament is important. And what that implies is the ability to know what it is that they should avoid doing. If that doesn't happen, you will have the same things happening again and again and again. The SEBI chairperson made a very interesting comment, a very thoughtful, enlightened comment, day before yesterday, I think, or was it yesterday? When she said, people must follow the spirit of law and regulation, not just the letter of law and regulation. To my ears, this was music. I have been a governance practitioner for the last several years. And I've been trying to tell those that have the patience and the inclination to listen that governance and compliance are two different things. You comply when you do something that somebody wants you to do. You govern your company well, you govern yourselves well if you do it because you believe it's right. My definition of governance is doing the right things at the right time in the right manner for the right reasons. That's all there is to it. It's not a terribly complex animal that you find difficult to engage with, right? So what she said was spot on. You can comply with every regulation and yet run business in a manner inconsistent with the interest of other stakeholders. You can do that. But if you are practicing governance, it's the spirit that you are catering to, not the letter of the regulations. So I think that was a very good, useful warning that she administered to her regulated space, and I'm hopeful that other regulated spaces will also take a lesson from that. Since you're all intelligent people, I assume that you would have played chess at some stage in your lives, even if business standard keeps you busy and you can't find the time for that. It's all about chess. If you are complying, you're playing black pieces. Somebody else has played the white pieces. When you are in the space of good governance, you're playing white pieces because that's the right move to make, not because you're responding to somebody else's. If you go to the United States, you will find hoardings as you approach the toll gates, the checkposts. Buckle up, it's the law. I'm sure many of you have seen this. Buckle up, it's the law. That put on your seat belt, somebody will catch you otherwise. The reason you buckle up is not because it's the law. That's compliance. You buckle up for your safety, that is governance, right? So I'm giving you two examples, one from chess and one from the streets of the United States, to show that there is a fundamental difference. So just saying we are compliant, it's a threshold condition. If you're a listed entity, you have to comply. It's non-negotiable. You have no choice. But doing something higher, doing something better, doing something that better protects the interests of those whose universe you regulate, or in which you are regulated, that is governance. How is India's track record? I am asked once in a while. Many people talk about Satyam, especially Indians living outside of India, whose attitude to India is very well known. The minute they catch a flight that takes off from Mumbai or Delhi, they share with the guy sitting next to them everything that's wrong about the country they just left behind. You'll never see the Chinese do that. You may beat up the Chinese, you will not get that out of them. They will not talk ill of their country to a non-Chinese. They won't do that. But we do that. So we get asked sometimes, how many more Satyams are there in India? And I have to tell them, I have the advantage of having studied the history of regulation for a while. So I give them a few names, I throw at them. I say Enron, WorldCom, Global Crossing, Parmalat. None of these are Indian companies. When did you last hear the name and in what context? And then they back off. After that, they back off. Right? Now, the issue is we must be proud about what we've achieved, but also recognize that there is a very long way to go. In my consulting assignments, the biggest problem I face when I engage with corporates is to be told we don't have a problem. When somebody is in denial and says we don't have a problem, that is the biggest problem that any individual or company has, because you are living in denial. And then what happens next, I call it the 3D formula. This is my own formula: deny, defy, decry. First you deny, then you defy, and then decry the guy who gave you that advice, right? That is not going to serve anyone's purpose, living in denial. The minute you go down that path, you are actually moving backward and not forward, not even standing still. That is something that needs to be recognized. And last thought that I wanted to share with you is this. Nation building has several aspects to it. No matter what we do, we're all engaged in the process of nation building. Whether you are writing, whether you're speaking somewhere, whether you're on a sports field where the national flag is flying, whether even if you are maybe driving the state transport bus, you're still contributing to nation building. Our collective endeavor should be to view these things positively. The minute we think that man bites dog is news, dog bites man is not news, and then you ignore good conduct saying this anyway we take for granted, but it's only when man bites dog and there's misconduct, there's something against the order of nature that then it occupies center space. That's not something which should be practiced by any of you, no matter what your pursuit in life is. It's not just about being journalists, etc. I wish all of you well. You have several sessions where the best and the brightest, the experienced and the experts will be sharing their views with you. I request you, I don't have time on my hands because I am doing something far more important. I'm going back to Delhi to play with my grandchildren who are visiting, which is at another level. Many of you haven't reached anywhere near that, but when you reach, you'll realize that. But stay back and do what the most celebrated football manager of all time, Ferguson, said when he was asked, how do you manage a team of motley individuals, each one of whom thinks he is God's gift to mankind? How do you manage them? He says two things: I observe and then I absorb. I wish you do that. I wish you well. Thank you.
Thank you, Mr. Damodaran, for setting the pace with that very robust address. I would now request Business Standard Editor, Mr. Shailesh Dobhal, to deliver the vote of thanks.
Thank you, Vinu. Like they say, after such a show, what can I say? Thank you, Mr. Damodaran. Thank you very much for that outstanding address, a very high quality address. It's very difficult to sum up such an enlightening address. For me, the takeaways were your prognosis on the whole regulatory capacity, excessive regulation, little compliance, how talented people are not commodities, and how we need to take the whole financial sector ecosystems, how the authority of advanced ruling needs to be there in all areas, all departments. I'm sure this audience and millions who are watching it online would have their own takeaways on your address. Once again, thank you so much. Thank you for being with us from Delhi, and have a great time with your grandson. We've kept you away. So thank you so much.
Be the preeminent banking partner for institutions with cross-border needs. Since establishing our first office in 1902, we have strived to bring India's ambitions to life. We bank 30% of multinational corporations, and 99% of all corporate transactions are digitally processed. Besides supporting the ambitions of emerging and mid-corporates through Citi Commercial Bank, we are the banker of choice to 40% of India's unicorn startups. While we deliver excellence for our clients, we empower communities, and we support young people in realizing their ambitions and connect them with India's heritage. We empower India. Citi, enabling progress in India for 120 years.
इस बार इंक्रीमेंट पे क्या खरीदने का प्लान है?
यार मैं तो अपना SIP बढ़ाऊंगा।
SIP तो हमारा भी चल रहा है, और क्यों बढ़ाना उसको?
देख, सिर्फ एक अमाउंट का SIP करने से नहीं चलने वाला। हर साल जैसे तेरी इनकम इंक्रीज होती है, so should your SIP।
वरना क्या?
तुम्हारा SIP तुम्हारी लाइफस्टाइल के साथ नहीं बढ़ पाएगा, और यही लाइफस्टाइल तुम्हें फ्यूचर में अनअफोर्डेबल लगेगा। अब समझे?
हर साल अपने SIP अमाउंट बढ़ाने से आप इन्फ्लेशन का मुकाबला कर सकते हैं।
and CEO Aditya Birla Finance. And in a conversation with them will be Business Standard Editorial Director, Mr. Ashok K. Bhattacharya. The theme of the discussion will be a very important one. It is becoming a bank still a dream for NBFCs? Over to you, AKB.
Thank you, Vinu. Very warm welcome back to many of us who were here in the morning. Just to say that we had a very, very fruitful discussion in the morning session. We had the RBI governor, and then we had the deputy governor, then we had a public sector bankers panel, and the private sector bankers panel is going on right now. And here we are with the country's topmost players in the NBFC sector. Once again, my warm welcome to all of you, those who are on the stage. What I plan to do in the next 1 hour is to essentially look at the NBFC sector, and as the name of the panel suggests, that is the dream of NBFCs becoming a bank unreal or real? And what I want to do in the beginning is to just present 3 or 4 issues that bother me as a lay person, and I will present it before the esteemed panel here, and probably request their initial observations on those issues. There is no doubt that the NBFC business is under some sort of a challenge. As we all know, that NBFCs from September 2018, with the ILFS crisis, came under a huge liquidity squeeze. And then the liquidity squeeze soon turned into probably a solvency crisis, you know. And I would like that business challenge to be addressed by the members here. That's number 1. Number 2 is what is the regulatory framework that right now governs, and something of an issue. Is that an issue, and what could be the areas which need further refinement, or which could need further correction, or is that regulatory structure okay? And number 3 is, and as a final point, is that to what extent has technology been a disruptor or a facilitator? Has it been embraced, or have fintech companies upstaged the NBFC sector? So these are the broad 3 points that I would like the panel to really reflect on. I would request the panelists in the first round to have maybe 3 to 4 minutes of opening comments on these issues, leading up to the larger question of the panel today, that is the dream of the NBFC sector to become banks coming closer home or not? So can I start with, I'm not a leftist, but I'll start with my left because there's nobody on my right. So I will start with Mr. Mistry. Mr. Mistry, please.
All right, so your first question was on financials, about 2018.
That's right.
So, you know, over the years, there have been periods of time when the NBFC sector has come under some degree of stress. I can give you the example of 2013, 2018, and to some extent for a limited period of time in 2020 when COVID set in. But I think the regulatory response at each one of these moments was very, very strong. And you saw that apart from ILFS, which was a different story altogether, not a single NBFC, sort of had to fold up or could not sustain. Also, I think NBFCs play a very important role in the market. There are sectors in the economy, particularly on the asset side, which banks are, for their own reasons, not able to lend, not willing to lend, which NBFCs do and do very efficiently. So In my view, the NBFCs have a big role to play. Maybe some kind of a backstop funding arrangement can be thought of at some point of time, where in crisis situations like you had in 2018 or 20 or whenever, there is some form of avenue or some form of funding which could be made available to NBFCs. On the asset side, they are very, very strong. On the liability side, there are some challenges which some of them face which can be tackled. Now, you mentioned 2020. 2020 was a time when we had the highest growth in deposits in a month. In the month of April or May of 2020, when the COVID crisis really happened, we had the fastest growth of deposits. So it's not that being an NBFC means that people will shy away from giving money to you. I don't think that's correct at all. On your second question of regulations, I think the regulations broadly have matched up. Today, there were differences in regulation over a period of time. These regulatory differences have all been patched up. Whether it is looking at non-performing loans, whether it is looking at just about anything. It's just the only thing left now is the CRR SLR requirement, which is there for banks, not there for NBFCs, but NBFCs don't have access to checking account deposits. And your third question of technology or fintech companies have a role to play, but in our business, for example, in housing finance, we have as our distributors, some of the largest fintech players. And the total volume of business that they're able to gather for us, honestly, is less than 1%.
Thank you very much. May I turn to Mr. Revankar?
Yeah, thank you. Not trying to repeat what Mr. has already said.
Yeah.
What I would like to say is most of the NBFC by nature or by the way evolution, we have come in as a specialist lender for specific asset classes, whether it's a gold loan or vehicle loan or housing loan. All of us have come as specialists, and some of us have moved into multiple asset classes after getting experience in that particular geography or particular asset classes. So the NBFCs are evolving, and on asset side, as Mr. said, we are very strong. On the liability side, yes, we have certain challenges because we depend on a wholesale funding from the bank, and many of the NBFCs do not have access to the retail deposits or loans. Some of us have only term deposit. But not having access to demand deposit itself is a good discipline for us in managing our ALMs much better. I believe the NBFCs have really grown and become part and parcel of the economy and contributing to the economy. And as even the RBI or even the government have understood this and supported us, especially during the COVID, the various support system which they provided through various methods were definitely helpful for NBFC and also for the economy. It helped the economy to keep moving. And as far as fintech is concerned, I believe fintech is an enabler. We don't see fintech as a competition or fintech is disruptive for any kind of activity for financial services, whether it's a bank or NBFC. So if you are able to engage with them, then it helps everyone to improve our services and also to reach out to the clients or customers whom we are not able to reach so far. I think reach, speed, service, all will improve with fintech is what I believe.
Okay, thank you. Thank you very much, Mr. Revankar. I like the way we are all moving very well on time also. If our answers and questions are brief, and then I think we'll have many more questions to be squeezed in. Mr. Iyer, your turn, please.
I think it's important to recognize that NBFCs have been built for customers. So the whole model of NBFC, if you look at it, is built keeping the customer at the center. It's a very retail model. Right? Therefore, reach becomes very important. Understanding needs of the customer becomes important. And the ability to therefore design the product to suit customer needs become important. And which is why at every stage, when a challenge has been thrown at NBFC, we have bounced back more strongly. The various instances that you talked of in history, every time you see, after that you've seen NBFCs becoming more stronger than before. I think the other important feature, why would NBFC survive and become larger, is the governance issue, right? In spite of the regulation, erstwhile were not very, very strong, just to pick up from where you said now they have become more stronger. But at no point of time NBFCs have breached any of the regulatory needs. I mean, you look at the track record of NBFC repayment to banks, like Umesh said, we borrow from bank, but we are one of the best repayer to the bank as an industry if you have ever seen. And that's a reason banks also want to lend more and more to NBFC. So therefore, you look at it from a governance perspective, I think NBFCs have managed the business extremely well, right? And the third on the fintech and the disruption that we talked of, I think gone are days where we have to start looking at anybody as competition. I think the time has come to actually become partners and complement and work with each other. I don't think any one of us can say that we will be able to do everything by ourselves. So therefore, we have to look at how and where can we use the fintechs where they are stronger. And they are likewise looking at us as a complementary partner to say, how can they use our services as to where we are stronger?
Okay.
Right? So if you look at from a funding perspective that you talked of, I think all of us are growing at phenomenal rates, 40%, 50%, 60% growth rate each one is putting out. And we have been able to raise funds for all of that. We are all very well capitalized as balance sheets. Okay. So I think NBFCs are here to stay. And my last comment would be, I don't think any one of us want to become a bank just because we think NBFC doesn't have a future. I think we have to start looking at it as what is good for the customer and what can create more value. And therefore, if you want to, from an NBFC, become a bank, that's a very different approach. To kind of start fearing and believing that, oh, NBFC may not survive, so should we become a bank? I think if you're not well run, you may not even survive as a bank.
Oh, that's a wonderful statement. I think we'll come back to that. Yeah. Just to get it right, Mr. Iyer, you said regulation is not a problem.
Oh yeah, I've always felt more regulation when announced, all of us react to say, oh, this is very difficult. Let's take the recent one, daily stamping, which was talked about for NPA. All of us felt it's very difficult for the consumer. Mm-hmm. But finally, when we believed that that's a reality, we have reached out to our customer, we have communicated to them, and I'm not for one saying that it's very easy. But ultimately, both the consumer and the lender both gets adjusted to the changing regulation and come out more stronger. And you see any regulation, I mean, one stage 365 days was NPA.
Okay.
It was made 180, we struggled. Then it became 90, we said it's difficult, we crossed the bridge. Now daily stamping, I'm reasonably sure that these regulations only make it more and more stronger as a balance sheet.
Okay, yeah. Mr. Singh?
So clearly, I think NBFCs play a very important role. If you see in the entire economy and the credit cycle, if you see there are banks, there are small finance bank, there are payments bank from a payments point of view, and there are NBFCs, which really play very important and last mile lender in a way, because there are a lot of niche NBFCs which are there and across the country in certain segment or certain parts of the country. There are gold loan players which are very, very big and very strong. In certain parts of the country, there are commercial vehicle loans, NBFCs. So there are different NBFCs which has evolved over a period of time, as Ramesh mentioned, in terms of looking at the customer needs and what is the value proposition which we can create for our customers. So clearly NBFCs, and if you look at the kind of credit participation in terms of 19-20% of the overall banking credit if the NBFCs have, and the rate at which they are growing, I think it can clearly go up to a quarter of the overall credit which the banking industry or the economy needs. So I think the role of NBFCs is well established and has been proven over a period of time. In terms of, and you gave an example, some solvency post September 2018, there has been examples like that similar for banks as well. And it's not just that one can say that only NBFCs have gone through this. It's more a compliance and governance issue, the model with which people run, and it's each to itself in terms of the way those institutions are run. So clearly, I think the compliance and governance structure of each institution is very, very important, and that's the reason how you will build a sustainable business for a period of long period of time. And so clearly, regulations are important, and prudent regulation. And I clearly, most of us are from banks. Rajiv is from bank. I'm for 16, 17 years of my career in a bank, now on the NBFC side. So we have seen both sides. It's not that we only look at NBFC and we aspire to be a bank. So clearly a lot of opportunity in the economy, which we all have to play. Banks have to play, NBFCs, small finance banks, and regulation, prudent regulation. And you spoke about the technology and the digital. I think the DLG, which the digital lending guidelines, which came from RBI recently, I think these are important regulations and interventions, because once size of this economy and the ecosystem becomes large, it will create a systemic risk. So it has to be addressed upfront in terms of what is the kind of regulation, what kind of prudence which we need. And clearly, if you look at from a regulation point of view, we are on Ind AS, which is we provide for expected credit loss for the entire life of the loan. And also on the IRAC, which is once on the 90th day. So we are on both sides, and it's quite stiff. And as again, what Ramesh was saying, it's lot to do with awareness of the customers who are, earlier they were aware that they can pay in 180 days and they're fine. So they will pay on the 175th day and they were fine. When the regulation changed to 90th day, then the same customers started paying in 90 days. Now, when the IRAC, which came, that the 90th day regulation, that if you don't pay 90 DPD, I think the account becomes NPA, and to upgrade, you will have to provide the entire critical overdue has to be paid. Now, once that awareness is created in the customers appreciate that, and majority of the customer align to that. There will be always be some part of some fraction of the customers who still will try and over a period of time align to that. But clearly, I think tighter regulations are important. In terms of building an NBFC, which is a sector which is sustainable over a period of time, I think as Mr. Mistry mentioned, the liability side is very, very important. Most of the time, the crisis comes because of the liability and not from the asset side. So clearly, banks have RBI as a last resort lender. You have in housing, you have NHB, at least you can go and get a refinance. For NBFC, there is no institution or there is no window from where you can go and get a refinance taken. I think these are the things which we need to address, so that otherwise what will happen is every 3, 4, 5 years, when there is an external crisis and banks or mutual funds or anyone stops and slows down, then there will be a question in terms of the NBFC model. So we need to find solutions on the liability side so as to sustain this sector.
Yeah, thank you, Mr. Singh. I'll come to Mr. Sabharwal, and the sense so far, Mr. Sabharwal, we have got is there's a tremendous, the positive energy is flowing in this room right now. Regulation is fine. NBFCs don't want to be banks. The NBFCs should remain as NBFCs. The problem is not on the asset side. Problem is on the liability side, which is a fair point. So what is your take on this entire scheme of things, given the way we have discussed it so far?
No, I think we've heard very good comments. Just, I'd like to add that if I ask you, please name number of banks which have faced death or near death, and number of NBFCs which have faced death or near death, your list will have probably more number of banks than NBFCs.
Okay.
It is not a question ever of NBFCs or banks. What makes an institution, even a manufacturing house, fail is either because of governance, because of poor risk management, or a business model. These are the three reasons why any entity fails, largely I would say. And that can happen to anyone, whether it is a bank or it is an NBFC. If you flounder on these, you will fail. It does not matter whether you are a bank or you are an NBFC. So I think that is what we need to understand. And for any of these institutions, go in through the long run, they will have to manage all of these. On the point of regulations, I think hats off to the regulator. The work which they have done in this area is really path-breaking. At a time when, there existed about, and today also there are about 10,000 plus NBFCs which exist in the market, we were all wondering how some sense will prevail on this. I think the regulator came up with these scale-based guidelines where they've given a clear direction on how they want this sector to progress. These are very progressive guidelines. They take into account the needs of the customers as well as the need for the companies to survive in the long run. So they've improved governance levels, capital requirements, the need to be, more information to be public, and so on and so forth. So I feel our regulator is moving in a direction in which I would say it's guiding the industry in a direction so that things become more safer. On the last point of technology and digital, I think in India, every industry is very competitive. You pick up any industry, it's probably more competitive than what you see anywhere across in the globe. And when you are, trying to get customer mindset or, the customer to move to you, you will have to make the experience better and better for him. And digital and technology is allowing us to do that. It is allowing us to be more customer friendly. It's allowing us to be more transparent. It is giving the power in the hands of the customer. And all of us are moving towards it. I don't think so. And today, any CEO can stand up and not talk about technology or digital in any conversation which he or she does. So I think it's part and parcel. We are just moving with the world. Some are moving faster than the others, but all of us realize that we have to move in this direction.
Okay, thank you, Mr. Sabharwal, which means that what you are saying is technology is not an intruder or an invader, it is actually a part of you and we are all embracing it. I'll come back to you, my next round will come back to start with you. I just want to request the audience here that, this is not just a discussion between myself and the five distinguished panelists here. I will like to come back to you with your questions. And Vinu, I hope we have the mics here because we will not wait till the end. Whenever we have the time, we'll come back. So please be ready with your questions if you have one. Otherwise, we'll continue the discussion at this place. So that's why I hope, Vinu, we have the mics here. Okay? Yeah. So let me come to you, Mr. Sabharwal. This is a question for me to understand. Why is it, if indeed there are more bank failures than NBFC failures, there's a sense I got from many others here. Why is it that in the systemically important NBFCs, with deposit-taking NBFCs, the number actually shrunk from around over 60 to around 40 or 40 odd so. So is that churn that is happening because you think the survival of the fittest? What is really happening? Why their numbers coming down? At a time when there's demand for NBFC credit, there are sectors that are really dependent on NBFC credit. Now, why is this the business, the entities that are in the NBFC sector, actually the numbers shrinking?
I don't have the numbers, but I never thought that the numbers of NBFCs have really gone down.
The systemically important NBFCs, which means above 500 crore numbers.
Okay, I didn't know that that number has really gone down, but
maybe ILFS effect also,
Yeah, see, you look at there also and you look at the number of entities which existed in that space. According to me, either it would have been a case of poor governance or inability to raise more capital, which led to a situation where that entity decided to merge with something else. Or it felt that, can today probably encash a better value than later. But if you talk about all companies which have been high on governance, and I can say this for people sitting on the dais here, each one of them runs an illustrious company which has set standards in their own space. There wouldn't have been a day when capital would have been short, or because of inability to access liabilities, they would have changed their business plans. I think if you have got your business model right, if you've got good governance, if your risk model is right, then there is no reason for any of the entities, whether it is bank or whether it is NBFCs, to actually look at anything but growth. We are all lucky to be present in this country called India, which today, not only today I would say, but in the past, has also supported growth for the world as whole. So today it's the fastest growing economy, and everybody is looking at how India has got to this model. So we are only riding that growth story which is present there.
Okay, thank you. What you're suggesting is probably NBFC sector as such is more sinned against than it is sinning. Anybody else would like to join this issue? Mr. Singh or Mr. Iyer? Mr. Singh wants to go first.
Yeah, so if you look at, I think post ILNFS and COVID, I think there has been some bit of consolidation in the NBFC, and it's clearly the event, both the events, if you look at, that has differentiated men from the boys. And clearly the capital or the sponsorship has moved to a better run NBFCs, better rated NBFCs, and that is one of the reasons why you will find that the lower ones, where they can't attract, let's say, capital, because from a governance point of view, from a compliance point of view, they don't fit the bill. So there has been some consolidation. And that's the reason why. So I thought I will just add to what you just mentioned.
Shai, you wanted to say something?
Yeah, I just wanted to add a point. I think one of the reasons why NBFCs keep surviving and keep doing well, while we are all clubbed under one industry, just look at this dais. We don't compete with each other at all. Each one of us have a very specialized model. Right?
That's right.
And that's the reason why we actually add to the industry growth overall. Now, I'm not sure whether an auto industry won't acknowledge or otherwise, but for NBFC, I'm not sure whether the vehicle sales would have gone this large and this deeper if it was only bank dependent, right? Because the kind of first-time credit, first-time buyer of a vehicle whom we specialize to finance is very, very large, and it's a very interactive model. So therefore, the point that I was wanting to make is, while you will see some consolidation in NBFC does happen, but each NBFC is a specialist in their own way, and therefore the collective strength of NBFC makes the overall economy grow, and therefore we don't fall, but we actually rise.
I think that's a very, I think we have got the answer to that question, that I think there's consolidation that is happening, survival of the fittest, it is not failure. Mr. Revankar, if I can come to you and raise an issue which nobody has as yet raised, and I would like Mr. Mistry also to respond if he agrees to, is that is there an issue about tax treatment for NBFCs? Is that seen as an unfair tax treatment? Are you sort of, in a sense, that some of the investments or the lendings that NBFCs does, the tax treatment is considered to be unfair, not the same as it is available, extended to the other financial entities?
I don't think there is any tax differential as such. The only differential as far as now, the way regulators are looking into NBFC and bank is the provisioning, because we are in a different, what you call accounting standards. Since we are in different accounting standards, the both balance sheet cannot be comparable. So there is definitely, the analyst or banks or RBI, when they look at NBFC and bank, you cannot really see them as on par with each other. There will be different angles. We actually provide much more than the bank, because our provisioning starts right from 30 days.
Okay, Mr. Mistry, Would you like to
So
add
one or
to
two,
it?
one or two minor differences might be there.
Yeah.
Again, I'm not a tax expert, so I won't be able to tell you. But for example, interest on deposits.
Yeah.
Interest on bank deposits gets some kind of tax benefits, whereas interest on deposits with housing finance companies or NBFCs do not get that benefit. So there may be one or two nuances like that, but I'm sure these are things which will get corrected. These are not intended differences. But as my colleague here said, the difference really between the accounting of an NBFC and the accounting of a bank is that banks follow the very traditional method of accounting, whereas NBFCs have moved to a much more stricter, a much more tighter accounting regime, which is under Ind AS accounting. So for example, as you said, provisioning. We have to make provisioning based on a completely different criteria compared to what the way the banks do it.
Okay. Can I ask you one more question, related question? You know, the bank lending to NBFCs, which NBFCs have used quite well. Now, bank lending to NBFC is no longer treated as priority sector lending. Has that been a factor which is worrying you or anything?
I don't think so at all.
I don't think so.
To the best
Less
of my
than
knowledge.
20 lakh loan
Yeah.
is treated as a priority sector loan.
So priority sector, that redefinition of thing has not yet really worried you or
It's
caused
not
concern?
worried because that now RBI has clarified. Earlier, RBI had allowed during this crisis COVID period, every 6 months they used to give extension on priority sector lending, what bank lend to NBFC. But post April, they have made it a permanent feature. So banks can lend to NBFC for less than 20 lakhs ticket size, and that will be considered as a priority sector.
That issue has been sorted out. Mr. Iyer, you want?
On the tax, I just wanted to add, the provisions that we make on the NPA accounts, we don't get the tax benefit. It gets added back to the income for the purpose of tax computation.
Okay.
And that actually pushes up the tax rate for no reason. Whereas for the banks, it's allowed as a deductible. So that's been one ask of the industry, and I think at some stage that will get considered since all rules are getting harmonized.
Yeah. Mr. Singh, if I can come to you, is the the minimum mandatory credit rating requirement for NBFCs, is that minimum mandatory credit rating that is required for NBFCs? Is that something that you need to?
No, I don't think these are the. If you look at from our point of view, we have internal rating of the SMEs. As I think Ramesh was mentioning, we are focused more on the retail and the MSME sector. And we have our own internal scorecards and internal ratings of the customers, which we do. So I don't know if there is a...
He's referring to bank lending to NBFC.
Yeah.
The smaller NBFCs cannot afford to get a better rating. So therefore...
So which is, I think, the point which I was mentioning the earlier, basis the rating and the governance and all, the capital or for that matter funding has got consolidated and all, and that is the reason why you see the lower end. So yes, the banks will have their own risk management and their own policies in terms of on which they will lend to the NBFCs. So below a AA or whatever they won't like to lend or whatever that criteria, but that's their own internal criteria. So,
Okay. Yeah, Mr. Sabharwal wanted to add.
If I may just add, I think one thing we should remember that still in India the credit penetration is very low. Whether it is on personal loans, by personal loans I mean housing or non-housing loans, still the credit penetration is pretty low compared to any of the near developed or developed world. We also know we are on a path where our per capita income is going to multiply over a period of time, and credit to GDP ratio will go up. At this point of time, I don't think so. It is about banks versus NBFCs. I think both of them have a role to play. Both of them have, I would say, a complementary role to play in this whole journey of making credit available to the final customer. If you notice, for all of us, give or take a few percentage points, 1/3 of our liabilities must be coming from banks.
Correct.
So they clearly are, the big banks are lending on their own, plus also through us, credit is reaching to the final customer. So it is a relationship which is helping each other, but we should remember the final objective is not about a bank or a NBFC succeeding. The final objective is for that individual customer or an individual SME to get the loan when they need it. Big corporates will always get it. But do all SMEs and the individual customers get it? I think all of us, banks as well as NBFCs, are driving towards that. In certain of our paths, we may be using each other to reach out to that final customer. Okay. The final objective is the same.
Okay. If I can come to Mr. Mistry, is the NBFC sector has a licensing issue which needs to be addressed? Licensing in a sense that, when NBFC is to start operation, it requires some sort of a clearance from the regulator.
I guess any entity when it has to start needs some clearance. Even when you need a bank.
Is it something that you are comfortable with? Is there something that needs to be?
I'm not aware of any issue concerning like.
Say, for now to start a NBFC, you need a 10 crores equity or net worth. That is becoming mandatory from 2024 or 25. All these days it was 2 crores was needed. So the NBFC can start small. Many of the NBFCs, they even found it difficult to reach 2 crores because they are only catering to the few people. Like second-hand two-wheeler financing NBFCs, there are people. So they do a particular community or society, a particular purpose they lend. So many people did not want to grow because they did not want people to hire people and make it a larger entity. So it's their choice, being a small or large. But RBI had allowed 100% equity into NBFC. So that is something which I think there is no restriction per se, I feel.
Okay. So
you can't start a lending institution without at least 10 crores.
Sure, absolutely. No, what I'm saying is that an issue right now? There's not an issue. Okay, fair enough. Is there any questions? Yeah, please go ahead. Yeah.
Not working.
Not working. Yeah.
Hello. Yeah, very good afternoon, sirs. As sir told that from banks, NBFCs borrow, but more banks have come to closer to closer than NBFCs, what sir started off initially. So what I want to ask is, how long we will continue to depend on banks to borrow our money and not compete with them? Why can we not be self-sufficient? When will we be allowed in future that we don't have to borrow from banks and we can also target the customers of banks also? Is that possible anytime in future?
My view is, when you look at our business, whether it is banks or NBFCs, our business is all about risk management. We are in the business of risk management. If we take too much risks, we will fail. If we take too little risks, neither will we grow, neither will we make money. We have to take the right amount of risks, measure it, and take appropriate action. Same is true for liabilities. I think all institutions, all good institutions, I'm sure who are present out here, will have multiple sources of liabilities. They are not dependent on a single source of liabilities. Similarly, within banks also, each one of them will have multiple banks from whom they have borrowed. That is again a part of the risk management strategy on the liability side. I think from our perspective, we have to widen this whole stream from where we will borrow monies so that our dependence on any one source or one entity is minimal. But wherever there is an opportunity, one should use those resources. So I don't think so there's anything wrong in NBFCs reaching out to banks, or in difficult times, banks reaching out to RBI, which also we have seen. There is nothing wrong. I think the whole system is designed in that manner so that it can help each other, so that in the long run, everybody survives with a simple final objective remains the same. Please ensure that credit reaches individuals or SMEs who need it. Again, I'm not talking about large corporates because large corporates anyway get credit. So that's the final objective. I don't think so there is any risk there, because within that also the risk is very well divided. And there is no single client on which we have a large exposure, no single liability source on which we have a very large exposure.
Interesting, you wanted to say something?
No, there was a question.
Yeah.
No, so on this point, if you look at the recent, and you asked whether the self-reliance for the NBFC sector in future also, the scale-based regulation which has come in, I'm sure it has come with some objective in terms of, and they want to see how these, the upper layer NBFCs behave over, and how the compliance and the governance and the business models are. And over a period of time, there will be some decision which will be taken, which might be a differentiated, some license or some way of reaching out. Because one of the challenges for an NBFC is we can only take care of customers' one need, which is the borrowing need. Customer has multiple needs, which we are not in a position to really provide that to him. And for that, I think some point in time, and that's the reason why this regulation has come in, and you will see over the next 2-3 years or 4 years that there will be some changes which will come in.
Mr. Iyer wanted to add something.
No, I just wanted to add that if bank lends to finance company customer, they will have recovery problem. And if we lend to bank like customer, we will have margins problem, which is why both models have created. So let's be very clear that we shouldn't be unnecessarily trying to overlap with each other, and you will have this issue to tackle, right? If at all you want to lend to a bank customer, now a new format has come, co-lending. Please work with the bank and lend to the customer. Why do you want to go and lend to that customer? Which is where in the marketplace overexposure is happening. That somebody is already lent to a customer, the banks have said limit is over, then NBFC says, oh, here is a great opportunity to give more money to the same customer at a higher rate, and then jointly we create bad customers. I think discipline by the lender, whether it's bank or NBFC, in the aspiration to grow, don't give up on discipline. Make sure that if somebody is worth so much credit, don't exceed that credit for your balance sheet purposes. You will have an issue to handle. So please don't look at competition and try and say, oh, if I get another institution, it can give me money, I can compete with bank. I think that's not going to work. We have been created for a specialized purpose. Let's focus on that and get going.
Mr. Mistry, you wanted to say, add something?
No, I would just add that don't look at banks and NBFCs as two completely different constituents. We are all part of the financial system in India, set up with the objective of providing funding to people who need the funding. And you should look at banks and NBFCs as partners rather than competitors.
Fantastic. We have one more question before we come back to our discussion again. No, I think a mic has to be given.
There's one more question there. I had one question. So the mic was with you. हमारा 4 में से एक ले लो यार, क्या करोगे?
No, it's all right. I think you keep it with you,
We have one question from there as well.
Fair enough, yeah.
Sir, today, banks are very reluctant to finance RA, resolution applicants. Now, what is the decision
Sorry,
of...
you have to be clearer.
Reluctant to finance?
Reluctant to finance resolution applicants at IBC. So if somebody who is bidding at insolvency as a resolution applicant, then banks are not willing to finance. So how you NBFCs are considering such proposals?
Nothing has come close.
I think the question is that resolution financing is not happening. Am I right?
It is not happening in spite of COC is mostly from the banks, but they are not ready to lend the new applicant.
Yeah,
But that would be a question in my view. If
Can we lob the question to the bank panel?
I think this is something that has to be taken on prudential terms. So probably,
Most of them could be a large ticket and where we have no specialization. See, ultimately, NBFCs work on specialization.
Yeah.
We don't lend to a business activity where we do not know, where we don't have specialization. Therefore, we keep it off. So I think banks would be better fit, or there are alternative funds which have come into India who lend into this kind of application. There are.
There are, sir.
Yeah.
But they then take good amount of profit rather than our own NBFC should take it. Because that big ticket size is almost over. Now most of the cases are in MSME, where you can apply your due diligence, consider, and then take a decision.
Definitely, we consider, I think we need to build some kind of a skill set and specialization in particular industry. If it is MSME also, there are so many industries there, whether it's a trading, manufacturing, or farming. And once we understand the segments, I think respect to NBFCs, we will take it. Definitely, yes.
Just let me quickly add, unless the opportunity size is too large, we should not jump into just taking one proposal because somebody else is not doing. The opportunity size has to be large enough for NBFC to allocate capital, right? It's at the end of the day, it's an allocation of capital that we'll have to look at. And therefore, if the industry size is not large enough or the opportunity is not large enough, I think we will resist. But on the lighter side, if we sounded like we are no problems and we are very energetic, we don't want to add more problems to ourselves. Let me tell you, we have enough of them.
I think we can go to the last the question on the...
Yes, and
Sir, your views on co-lending model.
Sorry?
Your views on co-lending model. We keep listening that NBFCs have started working on co-lending model. So how will it impact on the Indian economy coming time, sir?
No, I think it's a great move. I personally think that it's one of the very, very good initiative. And for a very simple reason that there are good customers who we source and probably we can't lend them at a rate that they are looking for, and as well as quantum. Right? So therefore, the two good institutions can come together and meet the final aspiration of that customer. I mean, we started with, ultimately, these models are built to meet the aspiration of the customer. I think it's a great model where the aspiration is met both in terms of quantum and the rate, and when you give a large quantum, even the period. So from an ALM perspective, from a rate perspective, as well as from the size of the opportunity, I think it's a phenomenal model. And then the risk is also shared accordingly, right? I mean, in the proportion of how we are placing the balance sheet with each other. So I think this is one of the best models, and it will really serve the needs, and the consumer base actually will broaden because of the three aspects that I said.
So is there, sir, any criteria that NBFC needs to take care of?
No, obviously, it has to be a well-run NBFC, high on governance, sufficient capital, NPA should be under its control. We should not be unreasonable in terms of charging. Our sourcing should be good. So there are very typical criteria. Even if we were to put out our capital, we will use the same norms. So it's not something very difficult to, kind of reach out to. So the norms are pretty normal, and we would have applied the same principles.
The regulation is already there. The RBI circular on co-lending is already there. So we are all evaluating in terms of how do we work with different PSU banks and all. I think it has to be the journey and the experience has to be created where there's not too much of fall off between the two institutions. So I think this works quite well with a lot of fintechs, but I think we need to really do and really replicate it with the large PSU banks. But the opportunity is huge from a co-lending point of view.
Fantastic. There's one more question from there. Yeah.
Hello. Am I audible?
Yes, you are. Yeah.
So I just had to ask this one question that maybe NBFCs don't want to become banks, but isn't CASA like a very big benefit which NBFCs can benefit from? CASAs.
Did we say we don't want to become
NBFCs do not have access to CASA right now. And I don't think it is likely to happen because, see, what is CASA? CASA is the demand deposit. Demand deposit means you need to keep excess liquidity with you all the time to keep servicing the customer. So the regulator has consciously decided that NBFC, because NBFC normally lend to a less banked customer, so underbanked or unbanked. So because of that, I think the CASA access to NBFC is something which we are not demanding, but we would prefer to have more retail deposit or term deposit, because right now it is restricted to only 1.5 times of the net worth. If it increases, we'll be very happy to tap into that.
Yeah, Mr. Iyer wanted to say something.
No, I don't know from where you got the impression that we don't want to become a bank. So let me first clarify this to you. I think what we are all kind of putting out is NBFC by itself has a great future. That nowhere concludes that nobody wants to become a bank. So let me first clarify that to you. Second is, if we become a bank, we'll get the benefit of CASA. If we don't become a bank, as NBFC, we have enough sources and there is a set of customer whom we can service on this basis. So they are two very independent approaches.
So
I would just add
please,
one.
Mr.
I would just add one thing, that both NBFCs and banks have their positives, have their advantages. You have to look at both of them separately. Just as there are CASA requirements for banks, there are also certain other regulatory costs on a bank because of the CASA. So you have to weigh both of them. I'm not saying banks are better or NBFCs are better. Both have a very important role to play in society.
I think what is very clear is that the NBFC sector must undertake a very serious awareness drive on explaining what is NBFC and what it is not and what it wants to be. So on a lighter note, my final round of questions, if there are no questions here, is just two questions. I think Mr. Sabharwal or Mr. Singh talked about refinancing options as becoming a problem. I mean, can we throw some light on what needs to be done or what can be done within the current policy framework, the refinancing options which is virtually absent, can be addressed?
No, completely. I think this is the point Mr. Mistry also mentioned, that the liability side. Today, there is, every 4 or 5 years, there's a question mark on the NBFC sector. That's only because in a stress environment, which can be driven by anything, global financial crisis in 2008 and 9, post that, the refinance window for NBFC. So banks have, and yes, there is a cost attached to that, but banks have RBI as a last resort lender. For NBFC, there is none. You have to depend on the banks, you have to depend on the market institutions, mutual funds, pension, all these institutions to borrow. So clearly there is a need that, and I must tell you that no one might avail of that facility which is created, because in 2008 and 9 there was, for a brief period, I think the government has created a window to provide refinance, and no one took that refinancing. But at least it gives you a comfort that the last resort, if there is a liquidity issue which is there where the institution can go and borrow, they can pledge their receivables and all, and they can borrow. I think that is what is needed, and something should be done at the NBFC sector level.
Okay.
Yeah.
Mr. Mistry, you are the veteran here. What do you think should be done to address this refinancing option problem?
So he made a very valid point that banks have some form of excess. There is a cost attached to it, but there is an excess. NBFCs don't have that. So that is one issue. Now, securitization globally can be seen as a model where NBFCs who have the assets could be able to package their assets, securitize their assets, and raise money against that. That is an avenue which is being explored, is being done, but maybe that volume could go up over a period of time.
Okay. We are coming to the end of this excellent discussion, I thought. And my final round of question would be to all of you, and which is that imagine a situation where the restrictions on corporate ownership of industrial houses owning banks, that is diluted or taken off. How many NBFCs would actually be very keen to become banks? So, Mistry first.
I think it depends on each group. I don't think it would be fair or correct to sort of make a very general statement.
Sure.
There are certain other conditions, like for example, ownership of an entity in a bank cannot be more than a certain percentage. Some industrial houses may not want their ownership in the bank to be below that level. So there are many such other issues which need to be explored.
Mr. Ravankar?
What I feel is, what is most important is the kind of customers whom we are servicing. If you are servicing mostly underbanked and unbanked, then you have a flexibility being a NBFC to service them. And if you are wanting to become bank, when your customer is mostly underbanked and unbanked, it is unlikely that it will become a good transition. So it depends upon the customer. I believe the respective NBFCs have to take a call. What is the best vehicle for them to service their customers?
Okay, Mr. Iyer?
I have 3 comments. One, your question assumes that we are not wanting to become a bank because the regulation is not allowing it.
Well, it doesn't, it was slightly to provoke you.
I think fundamentally one has to look at what do you want to do as a bank versus what are you doing as an NBFC. Right? If you want to continue to do what you're doing, I'm not too sure is bank the right format. So therefore, each houses, like Mr. Mistry said, will look at as to how one wants to look at it or whatever. I think my other comment is not related to that, but you said NBFCs have to make more publication about how important they are. I think if the word N is dropped, we are called non-bank. I think the N should be dropped. And we can probably be called as bank-like finance company.
Okay.
BLFC. So then I think automatically everything will be known.
You're saying bank-like financing companies.
Thank you.
That's a new phrase. We'll keep that in mind. Mr. Singh?
No, so clearly we will have to see and evaluate what are the guidelines to become a bank. And every corporate house or every institution will have to evaluate and assess whether it fits into their business model and a sustainable business model over a period of time. But clearly, I think if that comes in, it will be a big opportunity for the large NBFCs, and we should definitely evaluate and see how do we want to take it forward.
Okay. Oh, absolutely. Mr. Sabharwal, your last word?
I always believe that we all have to work within the regulatory framework, and I don't know whether daydreaming is good. I think we are very happy where we are. We feel there is a huge opportunity for the NBFC as well as the housing sector to grow, and we should tap that opportunity. So that is where we are. We are happy growing what we are doing.
Okay. I think, when in Business Standard, we take pride in starting a meeting on time and ending it on time. And thank you very much, gentlemen, for taking part in this discussion, throwing fresh light on the various issues. The broad message, if I were to write a headline on the basis of this discussion, is that NBFCs are happy with what they are, and they are not very keen or dying to become banks.
NBFCs have a great future.
NBFCs have a great future. I think my job is at stake, Mr. Iyer will take away my job. Thank you very much. I will hand it back to Vinu.
Thank you.
Thank you very much. Thank you. We'll break a bit and we'll be back at 4:30 for a fireside chat with the SIDBI chairman and MD.
Our vision is to be the preeminent banking partner for institutions with cross-border needs. Since establishing our first office in 1902, we have strived to bring India's ambitions to life. We bank 30% of multinational corporations, and 99% of all corporate transactions are digitally processed. Besides supporting the ambitions of emerging and mid-corporates through Citi Commercial Bank, we are the banker of choice to 40% of India's unicorn startups. While we deliver excellence for our clients, we empower communities, and we support young people in realizing their ambitions and connect them with India's heritage. We empower India. Citi, enabling progress in India for 120 years.
इस बार इंक्रीमेंट पे क्या खरीदने का प्लान है?
यार मैं तो अपना SIP बढ़ाऊंगा।
SIP तो हमारा भी चल रहा है, और क्यों बढ़ाना उसको? हाँ।
देख, सिर्फ एक अमाउंट का SIP करने से नहीं चलने वाला। हर साल जैसे तेरी इनकम इंक्रीज होती है, सो शुड योर SIP।
वरना क्या?
तुम्हारा SIP तुम्हारी लाइफस्टाइल के साथ नहीं बढ़ पाएगा, और यही लाइफस्टाइल तुम्हें फ्यूचर में अनअफोर्डेबल लगेगा। आप समझे?
हर साल अपने SIP अमाउंट बढ़ाने से आप इन्फ्लेशन का मुकाबला कर सकते हो और अपने लाइफ गोल्स को समय पर अचीव कर सकते हो। म्यूचुअल फंड इन्वेस्टमेंट्स आर सब्जेक्ट टू मार्केट रिस्क्स। रीड ऑल स्कीम रिलेटेड डॉक्यूमेंट्स केयरफुली।
इस बार
He's making his investments talk. Business Standard.
मैं देता हूँ। मैंने वैसे भी वचन दिया है, तुम्हारी सारी खुशियाँ शेयर करूँगा। थैंक यू। वेलकम। ये क्यों?
मैंने भी तो वचन दिया है, तुम्हारे सारे गम शेयर करूंगी।
कम?
मेरे खर्चे।
पिछले 100 सालों से ऐसी हर अच्छी शुरुआत का साथ दे रहे हैं हम, यूनियन बैंक ऑफ इंडिया।
वक्त बदल रहा है और जीने का सलीका भी। क्यों ना बदल दिया जाए सोचने का तरीका भी। अपनों की जरूरतों
Welcome back, everybody. We have with us Mr. Siva Subramanian Raman, Chairman and MD, SIDBI. And in a fireside chat, we'll have with him Business Standard Consulting Editor, Mr. Tamal Bandyopadhyay. May I request you to please come on stage? Mr. Bandyopadhyay. Thank you, and over to you.
Yeah, very good afternoon. And it's a fireside chat. It does not have any subject it mentioned. So, sir, I have the freedom to ask you anything we want. You were there at governor's program in the morning. So we have a very freewheeling chat and all. First is, a bit of confusion at times. We ask ourselves, I mean, why SIDBI there? What does SIDBI do? It's a DFI, but if there has been no SIDBI, would you lose out on anything? I don't know. Because you see the ICICI, IDBI, they got converted into bank. IFCI has become a penny stock or whatever it is, very small NBFC and all. So that's the kind of fate the DFI is faced. And that's left with NABARD and SIDBI. But often we are curious to know what exactly, if you can explain to us, there are not too many people, but still, what exactly SIDBI, the SIDBI, the animal, what is it?
Thank you for inviting me, Business Standard. Always a pleasure to speak with you, Tamalda. I asked myself that same question when I joined SIDBI, that what does SIDBI stand for, what is it supposed to do? And I can only tell all of you that the news is that after having been there for now 18 months, my learnings are that what SIDBI has accumulated over 32 plus years has been astonishing. And there is a certain skill set that has come about in the current SIDBI. I don't want to dwell into the past, but I think the other big question we have to ask ourselves is, are there any businesses that are still going to money lenders and borrowing from money lenders? So that is also a very relevant question, because SIDBI was created to take care of financing, promotion and development of MSMEs. MSME today is a definition which has actually changed multiple times in the last 5 years. Today it is about 9 crore entities, of which I would say only maybe 1 crore are under PAN and GST. The remaining 8 crores are all probably one-person businesses, which are scattered across the country, which are many of them, I would say even half of those 9 crores, are probably taking money from money lenders at 3% per day or whatever those rates might be. Very clearly, all businesses have a right to grow. All businesses are going to contribute to the GDP as and when they get formalized. And therefore, if India is looking at 5 trillion as a number, I think SIDBI is extremely relevant.
Tell me, one is MSME, that you yourself said that there's a 90 million MSMEs there, 99 crore, and if I'm not mistaken, is about 30% odd contribution to GDP, right? And then, of course, we can get into different segments of manufacturing, GDP, and services. I'm not getting into that. So that's one bit, and other bit, of course, your support to the MFIs. These are the two props in the SIDBI thing and all. But we don't hear much about MFIs anymore. So that wing of SIDBI is drying up, or?
So let me also be dreadfully honest. I think SIDBI is sitting on past laurels.
Huh? Okay.
So SIDBI did an excellent job of setting up the MFIs. Truly, I think, I recognize a few people here. There is certainly, even today when I meet any of the SFBs or the MFIs, their hearts are gladdened by the fact that SIDBI stood by them, helped them become MFIs, successful MFIs, become SFBs and then list.
Bandhan, for instance, Bandhan is
Is a great
actually
example of
your
that.
creation. You
Correct.
picked up equity when nobody knew about Bandhan, right?
Absolutely, absolutely. So I think, you know, there were some very far-sighted moves made by SIDBI officers at those times. But somewhere I think maybe, you know, last 5, 6 years, we have stopped looking at the next set of 100 NBFCs or MFIs where we must go in and support. So again, I go back to my point that what does the support of SIDBI give an NBFC? So I can surely I'm saying all of us in this room can count 100 NBFCs which are working in different corners of the country with probably assets under management of 10 crores, 5 crores, maybe 25 crores. But they're doing a great job providing credit to their hyper-local areas at 25, 30%. This is truly still a challenge in our country, how to give credit to businesses at reasonable rates. SIDBI has now gone back to its earlier avatar when it comes to MFIs. We have restarted the whole concept of identifying very small NBFCs, stroke MFIs, stroke NGOs. And once again, we are talking to them. We're looking at how to bring capital into them. But times have changed. So today you have a large private equity which has got created in the country. And I would say the other part of SIDBI's activity, which is the fund of funds activity, has gone and provided funds to many, many venture capital and private equity. But still, I will say the private equity will chase the upper end of the spectrum where the growth is fast, the money is quickly made. SIDBI is there for a development effort.
But is it correct to say that often we hear that you are sitting on tons of money, but you are conjuice, don't give money?
I'm happy to, you know, prove you wrong. And I think what SIDBI really does is that if I just take a macro number, about 25 lakh crores is the lending to the MSMEs across the country. Overall.
25 trillion.
Of which SIDBI has got a portfolio of roughly 3 lakh crores. So it's not a small percentage. It certainly can grow. Our main way of financing is refinancing the MSME portfolios of banks and NBFCs. We do direct lending to MSMEs, which is about 15,000 crores. We are now moving very, very strongly into micro lending, which is the space between the MFIs and the NBFCs or the banks. So people who need between 1 lakh to 5 lakh, they probably are missing both the MFI as well as the banks. So there is a lot of work that needs to be done. We have to be clear about, one, our role as a financier, and two, probably which I think is more important, is our role as a development or an ecosystem builder.
In that context, if I'm not mistaken, you did launch something called Prayas, which is slightly not like 50,000, 1 lakh, little more than that, but at a very low interest, I mean low cost, interest cost, etc. So how is that being?
It is truly a great journey. So today Prayas has got about 600 crores of micro lending, which I define as somewhere between 1 lakh to 5 lakh. We have got partners. So again, we are not a large organization with, you know, several thousand branches. We have 75 odd branches. But micro lending cannot happen through those branches. It is at a much lower level. It is at the village level or the, you know, small towns. And that is where we have built partnerships with several different people. It could be MFIs in some place. It could be NGOs in another place, banking correspondents. So the whole idea is that there is a shared model, something similar to what RBI has started in co-lending. So we have got a fully digitized platform where the person on the street is available there with a tab, puts in all the data, sends it to us. We have a simple business rule engine, and roughly within 48 hours, we are able to disburse loans of those amounts directly into the bank accounts of those micro enterprises. So this is something which can scale up hugely, because we are again relying upon our partner institutions, and therefore we even take an FLDG sometimes from them so that there's a skin in the game. So it's about innovation. It's about looking at how you can get your money to reach so many more people. Very similar to, in fact, the whole ability to put your money into small NBFCs. The small NBFCs, if they were to receive money from SIDBI, either as equity or debt, will cause an SBI and a BOB to look at those entities saying, if SIDBI has done the hard work, then we can also follow. And I think this is really the role that SIDBI has to play, where it must take a risk where others do not have the means to, because you have the experience. This is the skill sets that have got formed in SIDBI over the years.
Thanks, Mr. Raman. This is about your profile, your positioning, your products, but actually the entire idea of having this conversation was something else, but because there is no title, I took the advantage of that. I thought, let me ask you some candid questions because we don't get you often in a public place. No, that green financing, that's very important, that the ESG, environment, social and governance principle and all. And SIDBI has been pretty active. I have heard you from different fora talking about your initiatives on ESG. Now, can you give us a sense, because we are talking about, we are claiming that it is India's largest BFSI panel. We are talking about everything, inflation, growth, financial stability. We should also talk about green financing. So why not give us a sense what's happening in India? Before that, I'll just give a few numbers, or let's not get into that. Let's not get into numbers, etc. I hear you only, and then if I have any question. Okay.
No, I think you've touched upon the future of all financing. So, if one really looks at it, there are many banks which have already started creating what is known as a green book. In about 5 years, SIDBI has given financing to about 300 entities under a World Bank scheme called energy efficiency, whereby there is a guarantee that is also available. So it's not just that SIDBI has given the money, it could be any bank that has given the money, and there is a guarantee that's available through this risk-sharing facility. We have already converted these 300 odd entities and saved over, I think, 0.3 million tons of CO2 equivalent. So we are all moving to an era where energy efficiency, solar panel, rooftop solar panel, these are the substitutes for power, which today is the fulcrum of any business. So we have also sort of reoriented ourselves fully. We have an ESG committee of the board. We have a full vertical that is looking dedicated at green energy. And we have partnerships with KfW, World Bank, AFD, because I have seen that the amount of money that is there in the rest of the world, which wishes for trusted partners in India to come and share the money and put the money through such partners. SIDBI certainly has got a great standing over the years, and therefore we have been having successful partnerships with many of the international agencies over the years. And therefore World Bank has renewed a huge partnership under the same energy efficiency. We are going ahead with a solar rooftop program with the World Bank. We ourselves have announced that before March, we will do 1,000 solar rooftops in 1,000 MSMEs. And roughly, the financing and the commercials work out very easily, because for about 1 crore or 1.5 crore, an MSME has got a solar rooftop which takes care of its entire power needs. And the payback is probably 3 years, 3.5 years. And the plant will run for another 15 years. So, the economics are well known. It's about making it happen. We have subsidized interest rates so that it's a little more, sort of incentive for the MSMEs to come in. And again, apart from the financing, we have taken up an awareness project in all the clusters of the country. So we've tied up with Dun & Bradstreet recently for a very simple sustainability perception index, which is a mobile-based. We are putting it across to all the industry associations with whom we work in the clusters, getting it across to their members, getting them to understand that if they do not take action today, they may end up losing markets, they may end up losing buyers, because people are asking those questions that how green is your manufacturing process, how energy efficient are you. So we are already building our green book. In fact, I'll just take a moment with a very nice illustration which many of you will probably resonate with. There is a Moradabad cluster. It's a brass cluster. It is traditional art and skills over centuries. All of them have got coal-fired furnaces. 3,000 units, all with coal-fired furnaces. You can imagine the longevity of life over there is probably still very low. We have brought all the partners together. We have brought the UP government. We already found that a gas pipeline had come in from Torrent. We brought in the World Bank team, and now we are, with our own money, converting 100 such units into gas-fired furnaces. Now, this is a long-term project. There are environment clearances required. There is, zoning laws of the UP government which have to be changed. But the great thing is that everybody is now willing to do it. So, I think the sort of clarion call from the top has gone down very well. And everybody is today looking at how to convert inefficient energy processes into more efficient ones.
You spoke about clarion call from the top. So I'm just quoting the Panchamrita goal that Finance Minister Narendra Modi announced at 26th session of the Conference of Parties COP26 at Glasgow. Now, what are the things? It says that enterprises need to keep a close check on their carbon footprints to help India meet at least 4 of its 5 Panchamrit target. That's what Finance Minister said. By 2030, what are the 4? Increasing India's non-fossil energy capacity to 500 GW. Number 1, meeting 50% of the country's energy needs from renewable energy. Number 3, reducing carbon emissions by 1 billion tons and lowering the carbon intensity of the economy by less than 45%. So these are the 5 things. Now tell me, this entire ESG or the green financing has been on the agenda of G20 since 2008, and now India presidency of G20. So how do you see the things unfolding? What should we do? To grab this opportunity and come back, still the limelight and push the causes.
So, over our learnings over the last, decade or so, we have found that the guarantee scheme is an excellent way to galvanize money. So what we have done is that under what is a very popular scheme called CGT MSE, which all banks have fully integrated into for several years, we have revamped that platform and made it fully digital. One of the biggest pain points for a bank is that when you want to put a lodge a loan under the guarantee scheme, you have pieces of paper and so much of cost because of people doing a manual job. So that entire thing has been fully changed. So today the bank's loan management system is linked through an API to the CGT MSC, and therefore even when you want to lodge a claim, that entire process has been digitized. It is a small thing to say, but I can tell you, MD of SBI has personally rang me up and said, thank you for doing this, because you do not know how much money is saved at SBI for just pushing in, these kind of loans into the guarantee system. So what we are doing is with the World Bank, and we're happy to do it with other people also, create guarantee schemes for solar rooftop. I'm sure all of us in this room are very clear that what solar rooftop can do for this country. You can think of it, every MSME unit of some standing which has a concrete roof and a rooftop can easily bring in a solar plant on top of that at a reasonably low cost with a very good return on investment. So this is something which we are taking up in a very, very serious way. We've already worked out with World Bank. As I said, we are taking it up with Tata, with Mahindra. We are looking at smaller players who will have agents in every small location to maintain those solar plants, because maintenance of those plants increases the efficiency of those plants. So it's a huge new ecosystem. If you ask me, we are creating in the process many more MSMEs which are just going to be doing this job of creating and maintaining solar plants. So that is for me one of the biggest, sort of ways of taking forward the Panchamrit.
Tell me, you spoke about particularly green energy segment, but it's your scheme. You're not talking, but I was going through your website, and that Srijan scheme where you are giving for innovative ideas, and it's a very, very low, I think 3%, 3 to 5% interest for this Srijan scheme. Again, it's for energy efficiency, but not exactly green energy. So how is that panning up, or is it?
Again, as you said, it's very nicely designed, but I think the implementation is few and far between.
Okay.
So we have got some excellent schemes in that, some very good people we have supported in that, but it needs to be scaled up. So what we have got is the learnings of the last 5 years, where we have put out 8,000 crores to the AIFs in the country under the Fund of Funds program. That has gone to 800 startups. The startups today have already started returning the money. In fact, a Fund of Funds program is a perpetual program, because once the 10,000 crores is given out, it will come back, and it will come back in more than 10,000 crores. So again, you redeploy that. But what we really need to do, and we are working very actively on this, we've already started putting our money into incubators and accelerators. So Srijan is just one more case of a rural innovation fund. And therefore, we need to work more with people like the National Innovation Fund, which actually works. It's a SIDBI entity of 15 years ago. We've stopped working with them. We need to restart. Like this, there would be many other persons who would be able to bring in equity to a variety of small projects. The innovativeness that I have seen in the rural area. So we ran 3 Swavlamban challenge funds. These were just challenge funds thrown into the open public. We just invited it through newspaper advertisements. We got 65 responses in the first round, and in the second round, we got 460. You'll be amazed at the kind of talent and the kind of innovativeness that we have seen in the country. We have given, I think about 24 awards were given of 20 lakhs and 35 lakhs each. And many of these businesses just needed that to scale up. Somebody just scaled up on technology, somebody used it for some other purpose. So, our ability to go beyond loans and get into seed stage equity, I honestly see that happening. As SIDBI, we cannot be worried about is our scheme going to fail or not. You have to look at it as a portfolio. If you put your money into 1,000 such innovative schemes or companies, believe me, even if 50 of them work, you've got more than your money back. And that is the way the entire concept of seed funding works.
Can you tell us, we don't know much, but we hear that you are in the startup space, and there are different claims by your colleagues at different forums and that we have done this, we have done that. Exactly what are you, I mean, in the startup space, how many startups you have supported till now, what would be the money, and what would be the success rate? You yourself said that even if some of them do well, you actually worth your money. So give us a sense. We have 5 minutes left, so, and then one more question is there.
So let me just quickly
That's
mention.
the most happening space in India.
Yeah, so let me mention that, the funds, they are Government of India funds, first of all. We operate the entire scheme, and therefore it is known as the SIDBI Fund of Funds scheme. It has already got 14 unicorns in it, out of the about 800 companies that have been supported through startup equity funding. It is still early stages because a lot of these companies are going to go on for another 5 years before the need for closing those funds will come about, and therefore the disinvestment phase will happen by those funds, and the money will come back to SIDBI. So all I can say is that it has mushroomed a huge impetus and momentum within the country for people to get into startups, for people to be able to not seek jobs but go into startups and create jobs. So, according to me, the way the country's needs are, the way the educated youth are coming about, they need a lot more help. And that is really where I think SIDBI should go into more and more. It has already, done its job in terms of debt finance. It therefore needs to go into equity finance. And therefore, we've also got a scheme called venture debt. We've managed to get the government to agree to a credit guarantee scheme for venture debt, which will again support the startups once they go beyond the equity stage and they start taking debt in the initial stages. So, these are some of the more innovative things we're doing, but let me also just mention, the fact that we have gone about creating a formalization program with the Ministry of MSME, wherein those 9 crore entities will all get a Udyam registration, and with the Udyam registration, they will also be ready for what is known as the Vyapar credit card. So that's something which you may have seen was the announcement of the Standing Committee of Finance, which is very keen that SIDBI does two things. One, increases its support of NBFCs, and two, starts the Vyapar credit card, where even if you think of it, a small entity needs about 1,000 rupees of working capital a day to be able to buy products, sell it, and return that money. That 1,000 rupees can come from a Vyapar credit card at 20% interest and not at the interest rates of today, which are usurious. That is a scheme which can go through on a digital platform. So the number of Udyam registrations that are going to go through in the next 2 years, I would say the ambitious target given to us is 5 crores. So out of those 9 crores, probably 5 crore entities with the help of people like Mr. Alok Mishra and MFI, and where all those MFIs will come forward and give us the data and we'll be able to give it. And we reach a situation where every business entity simply needs to show its Udyam registration as proof of business. And that is a single registration which should be used by anybody to validate that, yes, this is an existing business.
So thank you for bringing Vyapar credit card here. I'm tempted to ask you, will it go the Kishan credit card way? Because we know the Kishan credit card for the banking segment, it's a huge black box. I don't know how much percent actually is banks get back. It's a perennially rolling over. So does the Vyapar credit card also run the risk of this? Once the money you give to me, I will never pay back, and I just get it roll over, and you claim the credit that you have issued so many Vyapar credit card, and you have changed the face of businesses, and you have given so much of money, etc., etc. But actually, the money never goes back to you. Will it go the Kishan credit card way, or how the Vyapar credit card? I know it's very politically sensitive. You need to be diplomatic, but how is Vyapar credit card different from Kishan credit card?
So, first, a very small technical point. Kisan credit card is not a credit card. So, Vyapar credit card is actually designed as a UPI linked or UPI based credit card scheme. And therefore, it is additionality. Now, no bank will give a CC limit to a small business. And therefore, this whole idea of the fact that we can have a Vyapar credit card, and again, I go back to my point, that can get covered under the CGT MSE scheme. So, we have today, in fact, you'll be shocked, Japan Financial Corporation is the world's largest credit guarantee scheme. It runs into billions of dollars. That's the way Japan has supported, even today. You'll be shocked, Japan has so many MSMEs which are supported by this corporation. This is the way I have seen India can grow. And this is really the way we would like to go ahead and create this kind of a credit guarantee corporation for even something as, sort of risky sounding as a Vyapar credit card. So I think there's a huge potential. I am very positive about the fact that our banks and our NBFCs will be able to run a Vyapar credit card scheme very well.
My last question, we have just almost finished our time, but quick answer is this. Is there any way, I'm not saying that you are suffering from any existential crisis. Probably you need to educate us, we don't know what you are doing. But is there any way to change it, like in the sense like the banks can, even though you are a public sector bank, you have many constraints, but you can hire talent for the market, give them market-related salary, put them in a different structure, go by CTC structure, allowing the monetization of entire thing, etc., etc. Like we had NAFED MD with us, and he is giving pretty good money to attract talent and all. You said there are many schemes, but its execution is not as exciting or as efficient as they should be or not. So is there any way to change if you have the ability to convince the government to reposition SIDBI? What are the few things that need to be done? That's my last question.
No, last and most difficult question. So I'm wondering how to duck it. So let me really first and foremost, the beauty is that SIDBI is not a public sector bank. It is an autonomous entity created under its own statute. Therefore, we have the ability to use the statute and create conditions for our staff and our operations which can actually be quite different. We are governed under what is roughly known as the NABARD and RBI kind of compensation packages, which, let me honestly tell you, is not bad at all. So, it is really about putting your mind and your heart into what you're supposed to do. And there's no dearth of taking talent from the market when you need it. We have already done it. I have an entire technology team which is completely from the market. And that's why we are running these large nationwide projects that we are doing. So, the rules that sort of run for SIDBI, I would not say are, overbearing or, tie our hands behind our back. If we want to do something, even if we put a proposal to the DFS saying this is what we want to do, I don't think DFS is ever going to look in and say that don't do it. Because finally, it's about nation building. So I think, the way an Aadhaar grew, I mean, Aadhaar was not constrained by money, but the beauty is that it did not really need too much money to grow, and whatever it needed was provided. So if you've got your projects in place, if you've got your design in place, your goal is clear, I don't think money is a constraint.
Thank you. So that's all from me. Here, Alok Saab is here, Samidda is here. You want to ask any question to him? However uncomfortable, he is fine. No? Nobody. So, yeah, quickly, sir. Can he? Get my mic? Yeah.
First of all, I would like to compliment Mr. Bandyopadhyay for his prodding and probing questions. Now, my question to you, sir, is that you have started becoming like an octopus. You are being given by government so many tasks that in that process, I think somewhere the idea of small industrial bank is getting lost because you closed so many branches also. Even right now, I don't know how many branches you have in Mumbai.
No, fair question. I mean, I think the fact that we may have closed some branches at some point of time is only a indication of the fact that when we run the bank, it is on a commercial basis, and therefore we have to run it as a profitable concern. We do not get equity infusion from the government. We run entirely on our own organic strength, and therefore the returns from our operations is the addition to our net owned funds, and based on which we go to the market and we borrow. We do get some concessional funds from the RBI, but as a share of our total borrowings, that's probably about 33-40%, not more, and it has been declining over the years. So our ability to borrow money on the strength of our AAA rating is really where we gain our strength. And as you may say that, the focus on lending has come down, I would, only correct you to the extent that because today all banks and SIDBI is at the forefront of that, we have converted lending into a digital-based lending, which causes operational costs to come down, which allows us to reach many more people. So, I'm also painfully aware of the fact that MSMEs could do with so much more of outreach, but we'll certainly try our best and get there.
Thank you, Mr. Ramanan. Thank you for being so candid, so frank, and not minding me asking you some apparently uncomfortable questions. And I think give him a big hand. So he never, he was not ducking anything. Pretty forthcoming. Thank you, sir.
Thank you very much, and that was quite a crackling fireside chat. Thank you very much. We'll break for a while and we'll be back at 5:30 for our next panel discussion, which is on small finance banks. Me? All right. 1 minute. Okay, we'll wait another minute. All right, our next panel discussion is on small finance banks. The theme is, can the small finance banks make it big? I would request our panelists to come on the stage, please. We have Mr. Bhaskar Babu, co-founder and CEO, Suryodaya Small Finance Bank. Please. Mr. Samit Ghosh, founder, Ujjivan Small Finance Bank. Mr. Alok Mishra, CEO and Director, Microfinance Institutions Network. Mr. Paul Thomas, founder, MD and CEO, ESAF Small Finance Bank. And Mr. P.N. Vasudevan, MD and CEO, Equitas Small Finance Bank. In a conversation with them will be Business Standard Consulting Editor, Mr. Tamal Bandyopadhyay. Over to you.
Good evening and welcome back. I'm sure you're pretty tired of me, but trust you me, this is one more time you have to suffer. I have one more session to do. So this is a small finance bank. All of them are between 5 and 6 year old. Not this gentleman, they are babies, the small finance banks. And the question is, can they make it big? Hand on heart, I will ask them that, how has been the 5 year or 6 year journey? Did you expect this way? Are you still a toddler, or a few of them actually have got up and started running? We'll see. It's a very interesting composition, you see. 5 of them, out of which this gentleman at the middle, Alok, is a professional. He is the CEO of MFIN, which is an organization, sort of SRO, what do you call it, for the microfinance entities. De facto, SFBs also, small finance banks are also into microfinance. So Alok's, if I say surveillance is not the right word, but what is the right way of doing it? Alok's connectivity with them is there. And the 4 of them, they are all founder, you know. Samit is the founder, and but he's not the MD, no executive role for him. That's Ujjivan from Bangalore. Bhaskar Babu, founder, and as well as Suryodaya, he is our homegrown New Bombay, Suryodaya Bank. Bhaskar Babu is the founder and MD and CEO. Then you have Paul Thomas, again founder and MD and CEO. So all of them are entrepreneurs turned bankers having executive role. And Vasudevan, as we speak, he is the MD and CEO, but it's in public domain, and ESF is Equitas is a listed entity. You have expressed your desire to quit, right? When is your last day, sir? When is your last day in the executive role? Achha, not fixed a date. Not fixed a date, but he said that, no, he is. So is it an expression of like he's tired of running a bank? We don't know. We'll ask him all these things. So, do they continue to dream big, or they find it that it's a tough time? And to be fair to the industries, this COVID came, and you know their business model, most of them are into the kind of business model they are, hugely affected by COVID. And I'm not getting into any particular entity, but all of them had seen surge in their bad loan portfolio in the past 2 years, but they are coming out. So there are issues on the asset side, the model itself. I mean, can you sustain? Because you are competing with NBFCs in some sense. for the assets, and you are competing with banks for the liabilities, and you are subject to very strict compliance. Unlike, of course, NBFCs are also coming up with that. So that's the context. So probably not everybody knew that life would be this kind of difficult. COVID had made it more difficult, but even otherwise also, because you are, as I said, repeating, competing with non-banking finance companies in the asset space. But unlike them, you need to raise liability from the public, for which you need to have capex, like have to branches, spend a lot of money, and also the regulatory requirement, the SLR and CRR and all. As an NBFC, you can raise money from the banks, and if you look at the cost of money there in absolute term, and cost of money loading all this regulatory SLR, CRR and capex, you are definitely paying more than NBFCs. So on the liability sides, it's a difficult. On the asset sides, again, it's a very different kind of thing. So that's the context. I'll not take much of time. I've already taken 4 minutes. We'll end sharp at 6:30, 1 hour, which is 55 minutes plus more there. We'll take a few questions from there, from you. No personal questions, no grievance redressal type questions, just related to policy and industry and macro level. Okay? And first round is all of you will give some sense where we are. Is the COVID pain behind us, and what else? And then we get into some micro issues. Samita, we start from you.
So,
Get the other. Achha, okay.
I just wanted to say that all of us, started 5-6 years ago. And this 5-6 years, we thought it's going to be a marathon because we have to build a bank, etc. But it turned out like a steeplechase, I mean, you're jumping hurdles, you're going through water and all that. Because it's not just the COVID, which was a big crisis for us, but as soon as we started, we had the demonetization, right? So we went through all this, and all of us have survived, So that is, I think, very creditable. During this period, I think we have grown significantly also. If you look, from an Ujjivan perspective, our book size when we started the bank, it was about 7,000 crores. Today, it's about 21,000 crores. We've gone through a very tough period of, post-COVID losses, etc. But today, we've recovered completely. And this year is a record year in terms of profits. In the last 2 quarters, between the last 2 quarters, we have made net profit about 500 crores. And this year, we are hoping to maintain that, that run rate. I think, whether we are going to be large or not, I'm sure we are going to be large. Because the next 5-10 years, we should be able to sprint, without too much, too many of these hurdles which were to us. So I think you will see a spectacular growth, among the SFBs in the next 5-10 years, and that's my prediction. Actually.
Okay, we'll get into the micro issues later. Bhaskar Babu. You are in the news, I read, I think yesterday or day before, all over the place. You sold your stake or something like that. So it's part of your stake. Yeah.
Yes, it's been pretty challenging. I think when we started, we looked at challenges as technology and liabilities, and demon happened, and suddenly those 2 challenges seem to have disappeared, and new challenge cropped up, assets. And we are kind of doing it, and then we had COVID. So it has been a rough road, to put it, and we are all hoping that it really leads to an expressway. So it was paved with quite a bit of a difficulty. But nevertheless, I think by either realization, connecting the dots now, or probably we reasonably knew but didn't know that it will be this difficult, is that I think banking is certainly a long haul game. It's not a tactical one. If you really, as Samit was mentioning, if you wanted to sprint, probably this was not the place to be. NBFC is far more clearer, tactical, step by step you can do yearly. And when we were starting a bank, people said the cost of compliance will be very high. Actually, we were really, really naive. I said, how can the cost of compliance be high if you do things properly as per regulations? Same as should have been an NBFC. But now I really understand the cost of compliance is something very different. It's not just wanting to be good, right, and doing the right things, you'll have to comply with so many things. So one of the challenges that we're all kind of learning, and probably it comes at a huge cost in terms of both time and money, is that we'll have to have the same norms like we deal with the public money as a large bank. There's cyber securities, database management, and so on. That has really kind of an added cost, which probably many of us, at least certainly I didn't really know this will be this high. And the SFBs did really take the brunt in terms of the COVID impact. At least the balance sheets and P&Ls of SFBs reveal that COVID indeed did hit the low-income households. Some of the NBFCs or NBFC as a whole has been able to manage it far more flexibly with a lot more agility, which probably as a bank we have multiple other things. So that's a learning. But the way in which I really look at it is that it's certainly a long haul game. We'll have to play it step by step. It's a compounding one. I think the biggest benefit which you have not seen, just that doesn't really make the risk management bad, is that the ability to really tap the last mile in terms of liabilities is a massive advantage which a bank has. When the time comes around for it, and we'll all be looking like probably good wise men.
Look, you hold on. I'll ask you to come at the end because you see the industry from your part, which is very different. You don't run any particular entity. Paul, sir.
Yeah, as Samidha and Bhaskar said, we also started the bank in 2017. It was a challenging journey. Apart from the common challenges of demonetization and COVID, we had another challenge we faced was in our home state of Kerala. We had two rounds of flood in 2018 and 2019. At that point, almost 50% of our assets were in Kerala, but we were able to manage that. And then immediately the next year, we started facing this. Apart from all other building up the bank. So 5 years, I can say that we built the bank. So we are ready to grow. Apart from 2 quarters in the second wave of COVID, otherwise we have been profitable all the quarters. And when we started the bank, we had only the AUM was only 2,000 crore. So today it is 13,000 crore. And we were completely depending on wholesale funding. So we could build a retail deposit base. That was the biggest challenge. People, media, everyone asked, how will you manage your liability? Because we are new to the deposit mobilization. So we could, 92% of our deposits are retail deposits. So that was, we could prove that we are capable of mobilizing deposits. So today it's 27,000 crore total deposits and assets put together we have. If COVID was not there, we would have definitely crossed 50,000 crore total business. So there was challenges, but we have learned how to manage the challenges. So in ISAF, when we started, 60% of our assets there was geographical concentration. So we have brought down that to 40%. So we were only in 8 states. Now we are in 23 states. So the geographical diversification happened, product diversification happened, team building happened. So the next phase, next 5 years will be not only for ISAF. I believe that the all SFBs will definitely grow because the foundations are built. That's my.
Thanks, Paul. We'll get into the nitty-gritty and the micro issues subsequent round. Vasu, over to you.
So Equitas, when we became a bank in 2016, we had 53% in microfinance and 47% was secured loans. We actually started our journey of diversification from 2011, so it's kind of a long-term journey that we have been going through. And the demon, like everybody else, had impacted us also. And our ROA went down to the lowest level of 0.35% in 2018 March. But when COVID happened in 2020, our microfinance was already down to 25%, and 75 was secured. Even though the impact of COVID was uniformly there on all businesses, still the lowest ROA we went down to was 1.1%. Even though all the customers were impacted by COVID. And the journey from 0.35 to a 2% ROA was a 7-quarter period between 18 and 19 and 20. Now, post-COVID, our journey to a 2% ROA is probably going to be 2-3 quarters, not 7 quarters like before. basically kind of giving us some amount of comfort from a diversified book that we have. And so the impact of market dynamics kind of not being as heavy as otherwise. And when we became when just before we became a bank, our cost of funds was 10.5%, and there was no cost of raising the money. I had two guys in the in the company to mobilize money from the banks, and our cost was 10.5%. When we became a bank, my cost of funds was 13.5%, because we were paying 9% interest rate plus SLR CRR cost plus some 3,500 new staff and 350 odd new branches, and I lost count of the IT investment. All put together, from 10.5% interest cost before becoming a bank, after becoming a bank, the cost of money, not interest cost, but cost of money was 13.5%, right? So we were worse than a double B rated NBFC the moment we became a bank. Today, that cost of funds is around 9%, which means that it is equivalent to something like a A rated NBFC. And we were a A plus rated NBFC before. So effectively, our cost of funds in a 5-year or a 6-year journey of the bank has come to what our cost of funds would have been if we had continued as a A-rated NBFC. Now the question is, over the next 5 years, hopefully our cost of funds, not the interest cost, but the total cost of funds, hopefully should keep trending down. And I think in the next 5 years, it should be better than a AAA rated NBFC and getting closer and closer to the banks. And I think that is a journey that I'm sure all of us, give or take 1 year here or there, will be going through. So effectively, in our experience, what we can conclude is that if you become a bank converting from an NBFC, typically you can look at a 10-year period, after which you can say you are also really a bank, because your cost of funds has to be like any other bank, which means your lending also will reflect more and more of a regular bank. So effectively, I think in our experience, we can say 10-year is a journey that one has to kind of look out for a NBFC converting bank to truly become a comparable bank.
Thanks, Basu. If I'm not mistaken, when you come to the diversification in the asset book, I think probably Equitas has the most diversified asset book, right? Am I correct in saying that? Is that so, all of you? No, the AU is, I'm not comparing because that's a different animal altogether. And when it comes to CASA, Paul, is it your bank has the maximum CASA among the SFBs? No? Again, Vasu only. Anyway, we'll come to all these things later. Alok, over to you. From the heading an SRO, how do you see the SFB space?
Well, I will not talk from the SRO angle, but because I am not for the SFBs, though they are our associate members, and very valued members. They were once primary members. I will talk from the policy side of it because I have been part of the panel on too many panels which touched on SFBs. And the question often asked is, will SFBs make it, or like that and like that? So because if you look at the financial sector in India or any sector in India, one thing is very common in India. One, we celebrate success too early, and we start talking about doomsday also too early. Now, in case of SFBs, let me put some figures into perspective. Because average vintage is 6 years. Out of that, I say 4 because 2 went in COVID. So it is approximately 4 years. In 4 years, if you see in the total banking business, the share of, that is scheduled commercial banks, RRBs and all that, the share of SFBs is coming close to around 2% in case of deposits as well as in advances. But if you take RRBs, which were all over India, 79, more or less similar mandate which was given as to SFBs, 178 RRBs at one upon a time, now amalgamated into 43, but reach remains the same. Their share in total business is 3%. So in 4 years you are at 2%, in around 30 years you are at 3%, and still being said that you are, you are not being able to succeed and all that. I think that's not fair. We have to give more time to them, as Vasuji was telling. For the lending rates, for the cost of funding for the SFBs to come nearer to mainstream banks, which is at 6%, 5.5%, will take another 5 to 6 years. But even then, I would say that the asset side challenge for SFBs will continue to remain, because they cannot get into mainstream corporate banking and corporate lending. So you will move up maybe to 10 lakh, 25 lakh, 50 lakh bracket, and much of it, and that is the toughest nut, I would say, in lending piece to crack. Microfinance loans, now settled piece. You can go and give microfinance loans, small piece loans. Larger loans, collateralized loans, easier. Project financing, easier. But this loan size between 2.5 lakh to 15 lakh, that will be tougher. So that challenge will continue to remain with SFBs. But I am hopeful, later on I will come back on that. Because why I am hopeful? Because there is a special niche for the SFBs. And I personally feel that SFBs should not, they can take their individual journeys, but as a outsider, I would only say that they should not start aping the private banks, the mainstream private banks. They have a special niche to play, and that niche potential is very huge. The green shoots of ecosystem building is happening in that, and that space, because in the just the session before in the fireside chat, the CMD of SIDBI was telling that there are around 6 crore MSMEs in India, out of which 95% are the bona fide market clientele of SFBs. And I was reading a BCG report, it says there only of these 6 crore micro enterprises, their unmet credit demand is somewhere around 60 lakh crores. Huge market potential is there. Rails are being built in terms of Udyam number or digital thing. And I think in next 5 to 10 years, you will start seeing results.
Thanks, Alok. Before getting into the next round, just for the audience, I'm sure it's a very literate audience, but still, what are the SFB animals? Just get a sense. During Raghuram Rajan, when he was the governor, 2 sets of new banks were given license away from the universal bank. One is payment bank and another is small finance banks. Now, the payment banks, RBI would not officially accept, but it's a failure, because what would a payments bank do which a commercial bank cannot do? So which is why even though 10 banks were giving licenses, not everybody started businesses. Even those who have started businesses, not everybody is continuing with that. Look at the small finance bank, 10 licenses were given in the beginning, out of which 8 of them are MFIs and 4 of them are from that space. One, which is AU Finance, is secured NBFC, and another is local area bank. Am I correct? So that's 10 of them. And subsequently we saw PMC Bank been taken over by the Centrum Group. It has become a small finance bank, Unnati SFB, and 2 cooperative banks have been converted. Now, we are not getting into sort of vital statistics of all the banks, but not every bank is doing well. I'm not getting into that. The reason being, most of them, as I said, they have come from a space which is unsecured lending and all. So I just want to start with probably Bhaskar Babu, you gave us and all. Is it a time to change the model? I mean, you can't, unsecured lending, this demonetization came, you yourself said, and then COVID, and something else tomorrow will come up, then the state elections, then different kind of elections, then the loan waiver, etc. So you are always, subject to all these external risks. So is it the time for the SFBs, if they really want to make it big, actively to take a close look at the business model and change it?
Absolutely, Tamal. So, Tamal, it's like this. Earlier, as a MF5, we are kind of used to do a cookie cutter, single product, fast churn, scale, repeatability. I think SFBs today approximately cater to, as Alok gave the figure, of 2% in terms of banking assets, but it's approximately around 7% of the Indian households. Around 3 crore, you take unique customers as 2 crore, of 35 crore is around 7%. So that's a massive, you have reached around 7% of the households. Earlier, it isn't easy to diversify in banking, that you hire the best team, you put and then give the pricing and you give scale. That's the learning that we all have. So it will take time. You can't really rush in to kind of become the largest secured lender quickly at that. So the transition is happening. Either Ujjivan or Suryodaya is currently at 65-35, 65 microfinance, which is actually the profit pool, and then you start building the secured pool. For Vasu, it will be 80% secured, 20% probably unsecured, or 15%. I think probably for ESAF would be the same. So the transition is happening, but it is best that we really kind of settle down that nothing can get accelerated faster than we can manage. Then you are really building risks in the so-called secured portfolio, which is not really manageable. At least we have the reasonable experience in terms of managing the risks in an unsecured business. The only difference post-COVID, which has happened when we look at all the negatives, is that while 20% of the customers have delayed, defaulted, or become bad, of the overall 6 crore customers, 80% of the customers have paid when there was every possible motivation around, if I can call that way, in terms of not paying. So this time we saw a clear breakout that the customer who wanted to pay ended up paying. 80% good is one way of looking at it, but how to really manage the 20% which really kind of went bad is a challenge. But earlier, all of us, including MFIs or SFBs specifically, were looking at customers as account numbers. Past tracker record is good, 35,000 good, give 50,000, then 75,000. For once, I think where the microfinance regulations also really requires that, we have started looking at in terms of what the customer is. What is the household? So the requirements for within the household is no more. Microfinance customer is a customer who's looking forward to you to give a loan and pick it up. They have also graduated. They have a requirement for a two-wheeler loan, a commercial vehicle small loan, a micro lab or a micro home loan, and in some cases a proper home loan. The son gets into a cognizant for a 3 lakh, 4 lakh. The household income has moved from 3 lakhs to 7 lakhs quickly at that. So I think our ability to capture that data, to dig in within our database itself is a pretty customer base, is a very large opportunity. I think all of us have started looking at it, as Salok said, 2 years, it was stray bullets hitting all over. Actually, we are lost in terms of where we are standing. I think we have reasonably, I would say that as a sector, we have got a grip in terms of where we stand. Equally important, it is not going to be all hunky-dory from tomorrow. We are all going to be kind of having 0.5% credit loss. Some of the business we are in is a 2%, 2.5% credit loss business, which does not show up year after year. So if we should now have the character of saying this is a 6% write-off in credit loss business at the end of the third year, fourth year, can we start really providing for it year on year in a year when the things are good, rather than saying that no, I didn't know it and suddenly once in a 4 year it happens. We have seen in Andhra crisis, and then we have seen Demon, and then post that we have seen COVID, and tomorrow, God forbid, it could be something else. But clearly it is a business which is a little high credit cost business, and the only thing about this is that it doesn't happen year on year. It happens once in 4 years.
Paul? This is the time to, the question was, or the issue is discussing it, to relook at the business model. You can't just depend on this unsecured loan and compete with MFIs and then become vulnerable to externalities.
Yeah, I don't fully agree that we should completely move out of the unsecured business. I don't believe in it. So I wanted to, in ISAF, we have a focus. We wanted to continue to work with the low income segments. So, but we will definitely, we are working on it. Today, when we started, it was 100% unsecured. Today, it is 78%. So, we wanted to, over the next 2-3 years, we will bring down that to 60%. It is all about perception. So, so how do we manage the perception? Recently, I visited, I went to a visit, and later I sent a team to BRAC Bank, Bangladesh. So 57% of BRAC asset is MSME, and it is 90% of the MSME. 90% of the MSME book is unsecured. The average ticket size is 7 lakh. So it is. They have a huge network in the field. There are more than 3,000 people. It's a high touch model. So I think if you really wanted to serve the micro customers. So, for example, we have built almost 6 crore microfinance borrowers. All of us have played an important role in doing that. So, what next for them? So, recently, in last year, we did a study among our customers. So, 25% of our micro loan borrowers create 3 to 5 jobs. They have a business. So, they need a high ticket loan. So they may not have a collateral to give, but the stock, they have the business, the hypothecation of their assets, all these things are possible. So government also have to think, so Alok ji is here, so we can work with the government, whether we can have a separate guarantee fund for such things. So unless we give this, provide loans to these segments. So I am talking about this, it is beyond the MSME, the regular MSME. These people are not the real MSME. They are in the below the so-called MSME, the nano. So I believe in continuing to work with them. So I'm sure we'll be able to manage us. But there is there will be, we'll find a way to manage the risk.
Thanks, Paul. So, Alok, now you need to respond because Paul says that SFBs should remain in this space in the microfinance and unsecured lending, but probably government should give some kind of guaranteed loan, guaranteed money, some kind of guarantee. But which is highly unlikely because that's one of the reasons why the DFI's model did not survive, because the government pulled the plug. The ICICI and IDBI and IFCI till the 90s, they were getting some kind of concessional fund from the government, and once that tap was switched off, then they got into the asset liability mismatches. So you are a listed entity, you are in the business of doing banking, why would government come and give you? I mean, that would be the argument. So anyway, Alok, because you are representing an organization which is a spokesperson for the industry and SRO, tell me, is it a time to change the business model or let the business model remain and look for some concession from the government, as Paul suggested?
First, I think if I heard correctly, Paul ji said that we will not exit this business line, but we will reduce the concentration on that. So that's perfectly fine. What business model to pursue, that is particularly left to the institutions. But I always said that my personal view is that based on the market niche which is available, they have to operate within a segment which is not at the corporate level, but what I say, the loan size up to say 40 lakhs, starting from 2.5 lakhs. And these are very tough loans to crack. Now, on your question of guarantee cover, why should government give guarantee? Well, if the government is serious, because even the fireside chat which you were having just before this session with Mr. Raman of SIDBI, he was also talking about that guarantee fund. And if you remember that he spoke that in Japan, Financial Corporation provides the largest amount of guarantees worldwide, even to its MSMEs currently. And he said that you will be surprised, but it is a matter of fact that in all developed economies, MSMEs who are formal, they have been formalized through a process, they have that guarantee cover to grow. Banks are at liberty, they can take some risk in lending to them. That has been the backbone of that economy. In India also, if we want an inclusive growth, and that is what the government says, and if we have to walk the talk, we are not saying that we are the SFBs or anybody who does this missing middle between the microfinance borrowers and bank loans to be completely risk transferred there, but some comfort to the banks in lending to a business where a very detailed appraisal is required, the documentation is missing. If some comfort is given by guarantee, I think it is a thing which is worthwhile for the policy to take up.
Samidha?
What we believe is, each of us come with a DNA and where we have competitive strength, And as far as Ujjivan is concerned, our DNA is microfinance and our competitive strength is there. So our base business is going to be microfinance. But we had also, as an NBFC, started our affordable housing, which is a secured business, and MSC this thing. So these are all part of what I would say why SFBs were established, to actually provide services to the aspiring middle class, aspiring businesses, and also affordable housing also falls into that portion. So over time, we expect that 50% of our business will be unsecured, but that will be largely microfinance. And there is a reason for it. Microfinance is probably the most profitable banking business there is, Net interest margin is around 10%. Which business in banking business gives you that kind of yield, It's incredible. And then we are trying to build both the MSC and housing business apart from the liability side, However, post-COVID, business which actually took over very fast, which accelerated very fast, was the microfinance business. It took us more time to build up the affordable housing and MSC businesses. So consequently, that target of achieving that 50% secured, unsecured got slightly pushed back. But over time, that's what we want to acquire. And the other thing I just want to tell you is, you will find that the SFBs offer best interest rates in the market. And that's for a reason.
For the depositors you're talking about.
Depositor side.
Yeah.
Because the yield we get on our microfinance loans, we can afford to pay that interest rate. So that actually gives us a competitive strength. But over time, as we build our MSC business, housing businesses, etc., it will require a different type of funding at a lower cost, etc. So, the liability management will become much more complex. So, as far as we are concerned, yeah, the business mix will change, but our core strength will remain microfinance, which gives us the best yield, and that's where our strength is.
Thank you, Samita. It's a very straightforward approach. What Shamit Ghosh is saying, that microfinance is where it's a cream of the business is it's a, like, where else do you get this kind of so-called NIM, net interest margin? Your cost of money is 10% and you are charging 21, 22%. So 10 to 12% NIM, where else do you get? Incidentally, what's your, because I'm sure there are many people who are looking to park their money and expecting saving deposit rates to go up further. What's your, I'm giving you an opportunity to market, or what's the maximum interest rate you are offering to depositors, Shamita? How much? Sir, use the microphone. How much? How much? You use the microphone, Adil sir. How much? Maximum, how much you are offering?
All of us are in the same range.
No, what you are offering, not sir.
8% something, but...
8% plus.
But
Bhaskar? How much?
8.75, 5 years.
8.75.
8.5.
8.5, 8.75. You?
8%. 8.
So those who are looking to park their money, you can heard that, between 8 and 8.75. Anyway, Vasu, you are the last speaker. After that, we'll take a few questions and we'll go back. As you see, I don't have any questions, etc. I have just a menu on my lap. There's no questions. So we're just going by the flow. If you wish to ask any question after this, please raise your hand and get the microphone ready. Vasu, you are already the most diversified business portfolio. Shamit says that he would like to, microfinance is the DNA, he will not bring it down, but 50% is fine. Rest of them said they will bring it down, but still microfinance will be the mainstay kind of thing. But you tell us, give us a sense what it is. But typically what we hear of late, that investors are not very excited about the space. They said, no, it's, it's not worth, because too much of external risks. We'll make money for 1 or 2 or 3 years, then entire thing will be wiped out for the next 1 or 2 years. Either COVID or flood or elections or loan waiver, etc., demonetization. Over to you.
Yeah, I mean, see, the SFB licenses were given by RBI for the purpose of financial inclusion, right? That's a preamble to the licensing guideline itself, because they believe that we have that last mile connectivity to the borrowers, and so if we become a bank, the borrowers should somewhere benefit because we are a bank. I think that theme continues and should continue, because that's the purpose for which this category was created. And so I think that should continue. Question only is, how do you balance risk versus inclusion? I mean, inclusion is a great agenda, no doubt. But at the end of the day, if you say that you have really done a great inclusion work, but financially, if your organization is stressed, nobody is going to accept it. Neither government nor the regulator, forget the market, will accept it. So you have to balance between wanting to be inclusive as well as wanting to be safe. And in Equitas, we find a lot of connect between these two. Approximately 15% of our microfinance borrowers are our small business loan customers, where of course they have to give us a security, which they do. But the fact is that even if they are willing to give that security, there's hardly anyone else who is willing to lend to them. More than 95% of our small business loan borrowers are NTC, new to credit borrowers, right? So which means that they are, as it is, excluded. So if I am able to give a loan to them, it's still a good amount of inclusion activity going on there. And we have introduced overdraft product for the small business people. and giving them a combo of term loan plus overdraft within the overall limit, and educating them how to use an overdraft facility. Don't just borrow the whole lot and keep it in your savings account or something like that. How do you manage an overdraft account? How do you get the benefit of the flexibility that an overdraft account offers you as a business guy? Which again we believe is a great inclusion theme. And if they taste the benefit of overdraft, surely at some point in time they will not leave you. Because NBFCs anyway can't do those kind of products. So I think within the financial inclusion space, we should be inclusive because that's a mandate for which this category was created. And if all of us get on to, in bridge infrastructure funding, one large, 10-kilometer bridge between some X to Y place, then what's the point? We don't have to have a separate category like this. So I think this category is important. Inclusion theme is very important. And within that inclusion theme, how do each organization balance the risk versus inclusion? I think that's where the whole thing should be, rather than should we be inclusive or not.
Thanks, Vasu. But each organization also has the dream of making it big, right? It's only the midway. SFB is the starting point. Then at the end of the day, maybe not after 5 years, but after 10 years or 6 years or 7 years, you want to become a universal bank. That's how you got into this space, no? You are not forever for inclusive finance, right?
See, big and inclusion are not mutually exclusive at all. Big doesn't mean that you have to be, you have to stop doing microfinancing or small business loans or small commercial vehicle loans and get on to corporate loans only. That I don't think is mutually exclusive at all. Big is only, we are talking more in terms of size, and like Bhaskar Babu and others were talking of, the affordable housing finance demand in the country is around 10 lakh crores. The small business loan financing demand in the country is around 20 lakh crores. Out of this 30 lakh crores, the total supply of all banks and NBFCs put together is less than 5%. Out of 30 lakh crores. So, yeah, a small finance bank, whether it is called small finance bank at some point or the small finance category drops and you become a bank, is not material. You can be a 1 lakh crore bank, you can be a 3 lakh crore bank comfortably. And yet be very, very strongly positioned in this niche market of inclusive space.
Thanks, Vasu. Yeah, any questions, this gentleman? Yeah, please. Very brief, no comment, just the question. And who are you asking?
Yeah, so my question is related to topic. Can the small finance make it big? The first is, where do you see your bank 5 years down the line or 10 years down the line? Each of you can have a comment on that. And the second is, see, you guys were doing asset finance, right? So asset is not a problem for you. How you going to raise your deposit, and what's your take on deposit in interest rate raising scenario? Thank you.
Okay. Any other question? We'll keep the questions. Yes. Yeah, please. You ask your question. Yeah. No? It was on. You must have. Yeah.
Hello.
Yeah. Just make it.
So you were talking about inclusion and growth together, right? So I'm trying to build a startup in the neo banking space. I wanted to ask, with the similar question, with the follow-up kind of thing, will you be open to neo banking like Surodaya or Equitas has ventured into to grow your liability so that you can expand your operations? And do you see that as a bigger opportunity going forward for small finance bank to grow larger, as the topic says?
Okay, liability. Yeah, one more, then we'll get back to the thing. Yeah.
Am I audible?
Yes, please.
So I have two questions. Number one, in the PSU banking space, we have seen consolidation by the government. So will we see the same thing in SFBs? Number one. Number two, I had done a decent amount of analysis on SFBs. I think, like Mr. Vasu said, that MFI business is a very good business on the NIM side, but when we come down to EBITDA and ROA, not a lot of money is being made in that kind of business from an investor perspective. Of course, from a financial inclusion thing, MFIs is a very good thing, but to actually churn money for the investors, I think it may or may not be the best thing. So Equitas, in the past 10 years has pivoted from 100% MFI to almost 15 to 20% MFI now. So will we see that also going forward with the other, MFI turned SFBs like Suryodaya, Jana, ESAF, etc.? Thank you.
So no more question, right? So there are a few questions. One question was that 5 years down the line, what's your dream? That we'll keep at the last answer. I mean, we are planning to have that. But other part is this consolidation, liabilities, and MFI, being an MFI into this MFI business, and you're managing your financials, we'll say that. So consolidation part, I think Alok, you should answer, because everyone else is an interested party. They are running their shows. You represent an SRO. Do you see a consolidation in this space? Like, few of them are really weak and they cannot survive.
Well, I don't think, because if I have to objectively see, not as an SRO, but as
Can you be objective, because your SRO run by their membership fees?
No.
You can't afford to chatao them,
Sorry.
right?
The associate membership, I would not give the numbers, but
okay.
But out of 12 SFBs, I would say only one has some financial, I would say, credit quality issues, and that is also not because of SFB's own making. It is of the making of the external situation. You call it the government or all that. You know that.
Would you like to name it? No.
Everybody knows it, so you know it well. You can name it, if you want it. So out of the 12, and one has got into that trouble. But if you talk about...
That's not a listed entity. Yeah? I think what he meant is just the one entity, but that's not a listed entity.
And that is not the entity's making.
Okay.
Other than that, while the AUM may be small, because typically in India, if you talk to an analyst, you will say a bank must have this much of AUM, otherwise it doesn't look like a bank. I don't agree with that, because, and that is where when you were talking about Rajan report, he was looking at the US model of small community banks which look at inclusion. So I don't foresee chances of a consolidation or merger. And in public sector bank, what he is talking about, that has happened due to their losses. That is because of their non-performance, and that is because of hidden balance sheet, because of government's recapitalization support and sovereign assurance. That is not there in case of SFBs.
Okay, that's one. So the next one more question was that it's good for financial, it's good to be in the financial inclusion space, microfinance, but not necessarily good for your own finance, the parameters. That's what you're saying. Samita, you want to, because you are insisting that this is on your DNA and you really earn higher NIM.
I don't agree with this. You know,
Sorry, please, be disagree.
I don't agree with that in the microfinance business, which gives you such a net interest margin. And we've seen the crises which we faced. It's not from the ordinary course of business. You know, our repayment rates are probably better than any other banking business there is. But when a demon comes, or Andhra crisis comes, which is a government intervention, or something like a COVID, all of us are affected, you know. And our return on assets are very good, you know, I mean, very good when we are running, you know, the business properly. So I don't agree with that. So
that's good. I mean, obviously, I mean, you can choose to disagree. So, gentlemen, you heard the answer.
I mean, in fact, you know, when we were an NBFC and when we were converting to a bank, a lot of our investors in the NBFC say, why are you converting to a bank? You're getting such a good return and, as an NBFC. Vasu smiling.
Okay.
So, you know, I mean, that's the case. I mean, if you run the microfinance business well, kind of return you can get is incredible, because it's a very profitable business, you know.
Okay. So the other part is, yeah, and if you also look at the numbers, the quick turnaround post-COVID in microfinance, because they are into the business where, you know, the cash flow starts the day one you start opening. Whether you are running a pawn shop, or whether you are selling mutton or chicken, or you are catching fish and selling everything else, is this. The day you reopen your shop, it starts giving the cash flow, and that's why they are able to pay back very quickly. That's the reason. On the liability side, one gentleman asked the question that raising liabilities is really very difficult. In fact, Samita said that somebody asked you that why you want to become from an NBFC, why do you want to become a bank? Yes, probably here's the reason, because if you are running a good NBFC, you can have the best of both worlds. You can have the margin by charging very high rates, what you are admitting, and at the same time you can also get low cost money if you are a good NBFC from the banks. because banks have their priority sector lending target, etc. They're always looking for the right kind of candidates to give money. So then you don't have to go to SLR, CRR, CapEx and everything else. So how difficult is the liability business? Probably Bhaskar, you are reaching to answer, it seems like that. You are offering how much you said, 8.5? 8.75.
5-year deposit.
8.75 Bhaskar Babu is offering.
5-year deposit.
Rush. Bole sir.
I think no, I would rather rephrase the whole thing. It is not you have a product orientation for microfinance. The inclusive finance segment is not necessarily now the poorest of poor, having no access to financial services, has no knowledge. 100% of the families are now digital, completely financially digital. So we are still probably trying to run the model the way we used to run it 10 years back. Model is quickly changing. I will probably little disagree with Samidha. He's saying that it is not necessarily going to be a high price business continuously. It is going to be a business where it is going to become competitive for well-paying customers. It's going to happen through digital means. But the only thing is that entire SFB sector, if I have to look at the fault line, is that we have looked at depositors as a separate. We looked at the people who are lending to be separate. But there are institutions like even the Grameen Bank where the amount of deposits from the same segment is more than the loans that have been given to them. It's a very, very hard work. It is very expensive. But the day we do it, the risk management will be very different when the next, God forbid, a COVID were to happen. Can the SFBs call up and say that, hey, don't worry, take your time, 3 months, as Vasu said, I will give you a OD limit, utilize it, relax, come back. 18% of the customers on their own have paid. I would guess that will be 90% if ever were to happen. But the fact is that we keep looking at everything as transactional, as product, high earning, then we are running a danger. If we can convert that into a relationship, then I don't have a fear that, God forbid, anything happens, I don't need to pay for a month. I volunteer and say, don't bother, take your time, 2 months. That will happen. The day that happens, then we're really talking about completely a different relationship orientation, not talking about microfinance as a product, but inclusive finance as a customer segment. That then will go back to what Vasu said. You will be in inclusion and you will be growing. You will probably have the customer stickiness, which probably, would say, NBFCs cannot have.
Thanks, Bhaskar. Actually, Bhaskar, you hit the nail on the head. I think all SFBs, you are running 2 banks. One bank is for Bharat, which is for the liabilities, giving money to subji vendors, to everybody else, to poultry runner, those who manages poultry and do jury work and tailor, etc., etc. That's the Bharat part, your bank. And on the other hand, you are running a bank for India, not only India, for Warden Road and Kemp's Corner and others, which is the rich, wealthy people, and the same which HSBC, Citi and HDFC and ICICI caters to. You are offering them more and enticing them to keep money with them. So that's a high net worth individual. Is that correct to say that? You are actually running 2 banks. And what Bhaskar was saying, it will be nice if you make the first one, the Bharat people, actually to make them into savers. Turn them into savers and keep their own money with you. That's the right way to go. Is that you meant?
Wait a bit. We process 12,000 to 15,000 death insurances every year. The sad fact is that beyond this, they don't have any other insurance, not even PMJJY. Probably if they have taken, the person who has taken has not informed their family, and hence the claim is closer to 0. Now imagine a situation where anybody dealing with an SFB automatically has an PMJJY, PMSBY, 2 lakh rupees, God forbid for this, 12,000 families, while the unfortunate thing has happened. I say, thank you ma'am, we have kind of processed, this is 2 lakh in your account. That's superb goodwill. So there is huge opportunity. So we are probably missing out in terms of lend, high rate, kind of borrow at a little higher rate from 2 different segments. The day the convergence will happen, and it's not easy, it's expensive, it is difficult. It kind of says that can it happen 2 years afterwards. But I think SFBs all will come around and say that that's the biggest goal pot we are really sitting on. Converge that, I think you see magic happening.
Savita, you wanted to add?
Yeah, I just wanted to add that, it's not just because of our interest rate people keep money with us. We did a recent survey of our customers, find out what attracted them to keep money with us, and it is service. We provide excellent service to these customers, which unfortunately none of the banks today are providing any of that kind of service. The other thing is the younger generation, if you have a good digital, mobile banking, this, that app and all that, and you offer them attractive interest rates, they keep money with you, So these are basically, the service and a good digital platform for the younger generation gets you a lot of deposits.
Thank you, Samita. We have about 7 minutes left because at 6:30 sharp there's one more session. We need to wrap up. Two important issues I would like to ask you, and one issue is Alok. Only you need to answer. Not you can tell us and all. The RBI new norm, which is pretty old now, 7-8 month old norm, from April it came into effect. Is this? It's microfinance is no more an entity-based regulation, it's an activity-based. That's what Reserve Bank of India has said. So I don't care whether you are a bank or small finance bank or whoever you are, the rules are same for everybody. So do you think it's a good thing? I mean, this will actually create a level playing field and this is an advantage SFBs?
I think it's advantage everybody. I think whether it is SFBs or NBFC MFIs or banks, and advantage client also. At the end of it, if you go to the field, Ujjivan would have lent to it, Arohan would have lent to it, and the client would not be able to say that Ujjivan is a small finance bank, Arohan is an NBFC MFI, Bandhan is a bank, and HDFC Bank is a bank. The client knows these are financial entities which provide loans. So if the regulations have become same, facing the client, I think it is utmost beneficial to the client, utmost beneficial for the responsible growth of the sector. SFBs also, of course, they are part of the important stakeholder. It is good for them also.
Anybody wants to add anything, or it's fine? So one more thing is, again, it's not, I'm not getting into again traditional India and Bharat, but normally what we hear from the SFBs and all, that lending in urban India is far more difficult than lending in rural India. Primary reason in being this, you will not be able to track despite all this, our focus on data collection, etc., you would not be able to track your borrowers. People from Bihar, Orissa, the migrant laborers, so on and so forth. They come, they put up shops, or they run auto rickshaws, or they drive Ola, Uber, etc. They give money, and they can just one fine morning disappear, and it's very, very difficult. So it's better to focus on rural India. There you can track them, and that's where the business lies. As far as this microfinance business, you call it, or unsecured loan, you call it, affordable financing, etc. That's a separate story because that's a collateral backed. So is that the correct approach, that it's urban India is a very different piece, difficult piece than rural India?
No, I mean,
when it comes to lending?
Tamal, as you know, we started as an urban microfinance, and I think Equitas also started as urban.
Yeah.
It's not a difficult task. First of all, bulk of the urban poor are not migrant labor. That may be 10% of the population. And most of us lend to people who are permanently living in the cities. And one of the things technology has brought us is geotagging of customers, which we learned during this COVID crisis, etc., which is a very effective way of tracking customers, where they live, etc. So, frankly, it doesn't make a difference.
Askar?
It's a little difficult. Certainly in a few cities, metros, if it is Mumbai, if it is Pune.
No, you are agreeing with what Samita says, or disagreeing?
Agreeing. Yeah.
Huh?
I'm not necessarily agreeing. So probably the overall thing in Mumbai, if somebody shifts from 1 lane to 3 lanes away, tracking them is extremely so difficult. So, and it has kind of shown up during the COVID that the urban losses have been far higher than the rural ones. You can still track people, you can keep going back to them and get it. But I'm sure some model will be there to kind of crack it over a period of time. But as of now, the urban microfinance is far difficult and rural per se.
And so it's, in other words, when it comes to liabilities or getting money, urban centers is pretty good. That's what the focus is on. When it comes to giving money, it's rural India. Is that the model?
No, both plays. Even rural has got both potential for liability and opportunity for lending, and vice versa also. We predominantly a rural semi-urban player, but we also operate in metros. We have started operating, and we have not if there is a proper system, so we can control that. And one area I think we all missed is that we have opened bank account when we started for all our micro customers. Bank SB accounts were open, but so far we couldn't really use that accounts for mobilizing savings from the poor. I think that one part we missed, and we are now started working on it. There are other banks in other countries have proved that. We need some regulatory support to do that. I hope Alok will take it up with the regulator for that. As I said, I think the one question we have not answered about the fintech.
Which was?
Just
quickly.
the partnerships. We are actually at ISAF, we did a fintech conclave last year. We are very much open. But the problem with all fintechs we have so far, everybody wanted to build their own customer base. So if you are open for a technology service provider, there will be definitely opportunity, and we are open. Thank you.
So we have just about 1 minute left, or 1.5 minutes. So one sentence each. This gentleman asked a question: how do you see yourself 5 years down the line? If Business Standard is holding a function in 2027, December, you are coming here. So what will be, you will be an SFB MD CEO or a Universal Bank MD CEO? What, Vasu, starting from you. I mean, even though you wished you have expressed your wish to step down, but it's more about your bank. The next 5 years, is it turning into a universal bank? Yes or no? Anything else? Just one line each. That's the last one. And get yourself ready to give him a big hand, because 6:30 there's another program will start. We need to rush. One more minute left. That's all.
See, this concept of universal bank and big size is not really connected. You can be big and you can still be a small finance bank. So the universal tag, in our view, is more from the liability perspective, because if many people say you are not really a bank because there's something different in your name, so you are really not a bank, and why should I put my money? So I'll go and say, okay, I'll give you more interest rate. So when I can take the tag out of the name, then I'm expecting that on the liability side, someday, I can start reducing my interest rate, and still people will have the comfort of putting money on me. Because on the lending side, I don't see any difference that.
Yeah. So whether I become a universal bank or an SFB, we will be remain the largest social bank in this country, catering to micro entrepreneurs, farmers, and the excluded segments. So that will be.
My wish list 5 years down the line would be SFB seen as the preeminent player in MSME financing space.
I would like to see ourselves catering to 1.5% of the Indian households, meaningfully impactful, highly respectable institution, make a pretty decent profit. This is what I would really see 5 years from now.
So the last word is yours.
As we discussed, we serve a much larger market, the aspiring middle class, the affordable housing, MSC, etc. So in 5-10 years, you will see SFBs will compete with any of the big private sector banks. And whether we are a universal bank, that's more a technical requirement of capital requirement. Universal banks have 8% capital adequacy requirement. We have 15. So obviously, we would like to move towards a universal bank. But I feel that in 5-10 years, there will be SFBs which will give HDFCs, ICICI, and all a run for the money in terms of size and profitability.
So extreme confidence, ambition, and optimism. Big hand to that. So all these gentlemen, they said that it's good going. There are, of course, issues, including the name itself, the Sobrico Small Finance Bank, comes on the way of raising liability, because people ask, who is this entity, where should I keep it? Small finance, not exactly a bank. But that's a disadvantage. Apart from that, there's nothing wrong with the business model. And they're pretty happy the way it's going. Only 1 out of the 10 entities that got first round of license is not in a very good shape, but the rest of them are pretty well. And they are pretty excited about the interventure and the days ahead and what's in a name, and you can call it whatever it is, but the fact is they are ready to give a run for their money to the universal bank, the ICICI and HDFCs. That's what Samita said. I'm not misquoting you, right? So thank you. We could have gone on, but we need to end it. If you have liked it, so give them a big hand. Thank you, sir.
Dilip Aspe, MD and CEO, NPCI. Mr. Sandeep Ghosh, Group Country Manager, India and South Asia, Visa. Mr. Rishi Gupta, MD and CEO, Fino Payments Bank. Mr. Vishwas Patel, Chairman, Payments Council of India. And Mr. Parag Rao, Country Head, Payments Business, Consumer Finance, Digital Banking and Marketing, HDFC Bank. In a conversation with them will be Business Standard Executive Editor, Ms. Nivedita Mukherjee. Over to you, Nivedita.
Hello, am I audible? Okay, hello everyone, good evening. This is the last session of a very busy day. And interesting thing is, through the day, we had so many sessions, and digital and fintech has been a common thread actually. So it's good that, we are wrapping up with this subject at the end of the day. And I will, like to talk a bit about, India driving the global digital economy. In 2022, the numbers suggest that we've had 70 billion digital payment transactions, which is highest in the world. So do you all see India becoming a cashless society, or do you see India coming anywhere close to the top three, cashless countries, which are listed as Sweden, China, UK? So, Mr. Asbe, would you like to take that question?
So, I think all of us are aligned with less cash than the cashless, right? I just hope CBDC makes some magic to go to the cashless. But I think all of us, ecosystem, the regulator, and everybody is aligned with the less cash society, and that's what we are looking at. So in my assessment, even if next 3 to 5 years time, if we go back to the single digit, the cash to GDP ratio, right? We should be happy as a ecosystem, because see, it's a large country. We have the challenges which some of the other countries do not have. While apart from the geographical challenges, the languages, the education awareness. So in our assessment, the less cash society with the single higher digit cash to GDP ratio, in my assessment, would be a success to the India's digital payment journey.
Anybody else who would like to add to this on India becoming a cashless society? It will be nice to have all your comments on this.
Should I go? Okay.
Yes.
So I completely agree with Dilip in terms of the assessment that from a cashless we have to move to less cash, and we can't compare ourselves with Norway and Sweden, which nearly only 5 million, maybe 7 million population. India is a very diverse country, lot of languages, lot of challenges on the ground. But I'll share some stats as far as Fino is concerned, and as you would know, Fino is largely a rural company, and we follow a phygital kind of a model with presence in more than 95% of the districts. So having said that, our customer segment is largely people in the 2 to 5 lakh rupee segment. So when we talk about cashless society, we are not talking about people in Bombay. We are talking about people who are there in rural and the hinterlands of the country. So in our own ecosystem, nearly 1/3 of our customers are now started to use UPI. So that's a big, big plus, which I see in terms of nearly 15% of the customers have started to download our app. And on our platform, we are doing more than 6 crores of transactions on the UPI every month. So that is the data which shows that we are progressing quite well. And as Dilip said, if from a 10-15% digital to 25, 30, 40% digital is something which one should aspire to. Becoming a cashless society, I think it's a far-fetched dream as far as India is concerned. But less cash is something which is more achievable. And I would say a lot of fintechs, a lot of banks, digital companies have started to focus on the mass segments, which is 700-800 million people. How do we make them digital? I think that's the way the direction is. And the data shows that, yes, we are in the right direction.
And you should probably also, for the benefit of the audience, dimension what we are talking about. So there's about $1.6 trillion of personal consumption expenditure that takes place in India. And of that, currently about 55 to 60% is still cash. So phenomenal progress made, particularly in the last 5 years in terms of the digitization, but there's still 57% of that volume which is still cash. So there is a fair bit of distance to traverse and a significant amount of cash displacement opportunity that continues to be there. And this is across, obviously, UPI, all the RTP rails, not just UPI, cards, etc., etc. So quite a distance to traverse there.
I'll just add to what Sandeep. I'll just add to what Sandeep mentioned. I think while of course digital transactions have grown significantly, I believe that in the next 5 years, both cash and digital transactions will coexist. Because even today, we have possibly almost 30 lakh crores of cash in circulation. And of course, as a percentage, that will keep coming down. But 5 years down the line, we will definitely be possibly the fastest growing, because a lot of innovations we have done over the last 5 years, which have given us these results. And those innovations, and a lot more innovations which are there in the pipeline, will really help accelerate digital. But in the medium term, or even in the next 5 years, both will coexist in my view.
Yes.
Hi, I think I'm going to echo what everyone, the panel says. We've got a long way to go. Less cash, I think, is the mantra, should be the medium-term mantra. As you know, cash is still growing. ATM withdrawals still growing, etc. And we've got, but I think the efforts done by the government, by institutions like NPCI and all the networks, and of course all the banks and the banking financial string, I think is wonderful. Expanding the market. So you've seen digital grow phenomenally. Great. Cash is still growing. And I think we've got to continue, plugging away at increasing acceptance of digital and keeping on going that. Two things which need to change, and these are more mindset. So one is this whole thing about compliance, tax avoidance is one phenomena I think still lies. The other is this whole reason why the government schemes are being pushed onto sort of electronic, which is, this whole leakage of money transmission which happens. These are things which are, how do I say, these are more of a mindset issue. So that's all, those things also need to be tackled, but we've got to continue plugging away.
So my next question is for Mr. Patel. We need to talk about regulation. Every speaker throughout the day has spoken about regulation. So let's get into that area. And do you think there's a level playing field when it comes to regulation in this payments and digital segment?
So after the passing of the Payments and Settlements Act, right? So RBI has become God now. So on almost every aspect of the digital payments, notifications are coming out, right from the second factor authentication to nodal bank to you name it, in the sense that even customer grievance to every other thing that is there. So now, with also the licensing coming in, with the payment aggregators getting a step, yes, it's getting into a level playing field. But what happens is that there is a pace that the digital payments is growing. These kind of regulations sometimes are beneficial in the long term, but in the short term, it creates a lot of havoc, in the sense that, say, a recurring billing, legislations, or many other things that come in. So sometimes I feel, since I started 22 years back, we were much happier then, just simply doing the business happily and solving all this. But as regulations come in, it makes it very difficult, because what happens is that there are various parts of the government. One part of the government thinking zero MDR and let's make it free and other things. On the other side, there is RBI that if you want a license, you have to be a positive net worth. Otherwise, come on, quickly wrap up your business and go. So one side we have to do the business for free, and the other side there is positive net worth and other things coming in. So yes, regulation is tricky, but I think only the experienced guys will be able to go through that.
So, Mr. Ganesh Anant Narayanan, COO of Airtel Payments Bank, I would come to you on regulation. You were the first payments bank to be launched in India. What has been your experience as far as dealing with regulation and regulatory authorities are concerned? And do you think the sector is over-regulated? And if yes, what is your ask from regulators really?
Sure. So yeah, we've been now 6 years in the business. We've got approximately 55 million monthly transacting users. Process transactions worth 24,000 crores every month. We're growing on revenue and we're profitable. I think that's been the journey. I do believe that over the last 3 to 5 years, some of the regulations, for payments bank have changed with the times. A classic example is where the limits, which was a lakh, which is what was the licensing conditions at that point in time, has actually gone up to 2 lakhs. Some of the video KYC regulations which came in, which really worked well for our digital customers, where they could actually open a bank account, seamlessly. Use of CKYC, in a far more proactive manner. I think some of these things have worked very well. And I do believe that, it's helped us grow in a very responsible manner. Because fact is, we are playing with people's money. And we need to be responsible towards that. We need to be conscious of that and work in a very sensible manner. So I think that's working well for us. I think, and I'm sure Rishi would also agree, I think one common, theme which all of us have for the regulators to allow maybe small ticket lending, as an enabler, because we've got the access. I think between the payments banks, there are more than 500,000 or maybe even close to 1 million BC agents in Tier 5 and Tier 6 outlets. Airtel Payments Bank alone has approximately 4.5 lakh BC agents in Tier 5 and Tier 6. Now, think of the power of maybe an assisted account aggregator platform, where we reach out to a customer in rural who does not possibly have a credit access. We are able to sort of get the KYC done and do the due diligence. Now, if we have the ability to sort of give out a 10,000 rupee or a 20,000 rupee loan at a reasonable price, I think it does very well for the customer. Otherwise, the customer has no choice but to go to the money lender and pay maybe 5 to 7% per month of interest, which in my view is criminal. But there's no choice that the customer has. So solving for this, I think we are very well placed, because we've got the infrastructure, we've got the relationship with the customer, we've got the trust which customers have with us, because they do anywhere between 16 to 18 transactions a month on our platform. This is Airtel Payments Bank customers on our platform. So I think a combination of all of this, if we can make sure that we are enabled with small ticket size lending, I think it will make a big difference to the economy per se. It will do well for to drive financial inclusion, and I think it will help well for the payments banks universe itself.
Thank you. Mr. Rishi Gupta, MD and CEO of Fino Payments Bank. So this is also called Figure Not. Is that so? Yeah. So how was it coined, Figure Not?
I think a lot of what we do is from the field. So in one of our field visits, I think one of the merchants said, Fino, F-I-N-O, means figure and not. So Fino hai to figure nahi hai. So that from there we made it Figure Not.
So taking off from the theme of the session, in search of a business model. So it is said that, players really haven't found the business model. It hasn't really taken off well. But do you think Fino Payments Bank has found the model?
So it's never over till it's over. So in a way, I will not say that we have found the business model. All of us are grappling, all the payments bank are grappling with what kind of business model will it sustain with. So what is important is that unlike many other fintechs, digital companies where the models are largely around investor money, fortunately for payments bank, the players, they are looking at sustainability as the business model in the long run. So from the time we started 5 to 6 years ago, that time also there were a lot of questions whether a payments bank can really make money, what kind of model it should come out. I think a lot of us are following similar kind of models at a different scale because we came at a different points of time, but similar DNAs and similar concept of making it an asset-light, scalable model, where rather than setting up a high fixed cost around branches and but more driven on technology and merchant ecosystem, we have been able to expand ourselves quite fast. Fortunately for us, we had the India stack coming at the right time. So whether it is UID, whether it is NPCI, whether it is the Aadhaar ecosystem or the mobile ecosystem. I think a lot of that came at the right time when we were starting the bank. So all of that, along with the model in which we build up the entire merchant ecosystem, we were able to make it a very sustainable model. We are now, in our 5 years of journey, we have more than 3 years of profitability. We believe this model, which I would completely echo with Ganesh, can be put to use in a very scalable in multiple products also. So like we have restrictions on deposits, and we have restrictions on lending, we have restrictions on FDs and RDs. So from a regulator point of view, our endeavor has always been to present to them the fact that this is one of the largest infrastructure which has been created in the banking in the last 5 years, more than 2-3 million points across the country. It can be put to a better use where we can bring all those 70-80 million people who come to our platform every month, where we can offer them loans and also raise our deposits and around those some of those products which we have been discussing. So model is continuously evolving. I would say from the state at which we were 5 years back, but completely everybody had written off the model from the day one. We are in a much happier state now.
So from model, I would like to go on to, a little bit deeper into model. Partnerships of various kinds seem to be a go-to model for many companies in the digital payment segment. Mr. Parag Rao of HDFC Bank, you are also experimenting with partnerships. So what do you have to say? Is collaboration the way forward?
Okay, thank you. I'll answer this question in the context of the previous question you asked about, is regulation sort of creating a level playing field? Okay, because regulation does play a role in any business model as we go forward. The way I look at, and it's probably a contra view, I look at regulation saying that level playing field, there should be level playing field for consumers. And I think that's the role of any regulator and any industry, forget about not just about the banking or the financial services industry. Every segment needs to have rules by which partners play, and those rules will keep on evolving as the segments grow. Okay, if you build a business model based on the absence of rules, then obviously there's going to be something coming in. And today, what you're seeing is a period in which we had some sort of regulation at point in time, and we're keeping on increasing. So I guess business models will need to keep on changing related to one of these important factors. In financial segment, we have to live with the fact that regulation is there. Coming to the point about collaboration and partnerships, I think...
Take the mic a little closer.
Okay, sorry. Yeah. Coming to the point about collaboration and partnerships, I think in the last 4 to 5 years, or 6 years you may call, with the advent of what we call digital and different ways of expanding markets, bringing in technology, making products and services much more easier and accessible as compared to the conventional way in which banks do, I think whilst in an ideal scenario, every player should be able to adopt and become a master of all. Okay, but that's not reality. And so therefore, the role of partnerships and collaborations is simply about saying that, can one partner bring his strengths? Can the other partner bring his other complementary strengths? And together, can you make a 1 + 1 = 2 or 4 or 6 or whatever, depending on how it is. And that's, I think, the way we do. Because, and if you ask me, in today's world, especially with at the stage at which we are in 2022, I think I see 3 approaches to the market actually playing out. And if you look at every initiative done by most partners, I think it's coming out. So one is this whole approach to the market of what I call platformification, approaching the market in a platform way rather than just a point product way. Embedded finance, that's the other key pillar on which I think the approach to the market is being. And of course, disrupting existing or conventional use cases and expanding the marketplace. Okay. When you look at all these 3, I don't see any one player, any bank, large bank, new bank, any fintech or even any network actually having the competency to straddle all. And that's where partnerships come into play. And therefore, I personally believe that partnerships is the way to go to make that 1 + 1 = 11.
Thank you. Mr. Sandeep Ghosh, Group Country Manager, India and South Asia, Visa. As somebody representing the card industry, what does the digital world mean to you?
Well, that could be a very, very long answer. So let me stitch together a couple of things that you have been talking about, and in some ways, it's also very, illustrative of what digital really means. So we talked about regulation in one of your earlier questions. I think what tends to happen sometimes is regulations from a consumer perspective focuses on security and controls, but it's equally important that regulations also keeps an eye on friction. And you have to get the balance between security, controls, and friction right. And so if you think about what Vishwas was talking about, regulations on standing instructions, card controls, two-factor authentication, a lot of that is important in a market, but you also need to make sure that these regulations then don't end up creating a lot of friction, because one of the key aspects of digital is that it's got to be paperless, seamless, frictionless, etc. Right? So that's one. Second thing is, in a digital world, things are kind of interconnected. So, when Ganesh and Rishi and others talk about the importance of why payments banks need to have the ability to lend. So you've got customers who've been acquired, who are transacting, who keep balances, and they also have a need for credit. And just as, the RTP rails in India, notably UPI and other forms have democratized digital payments, you also have a need for democratization of credit. And there's a huge role that payments banks can play in that respect. So again, that's another important aspect of digital, which is the democratization of various things. We've started with payments, but it needs to extend to credit. And then, you talked about partnerships, and, rather than give you a theoretical answer, I mean, you look at everyone on this panel, as Visa, we partner with Parag as the largest issuer and acquirer in the country, HDFC Bank. We partner with Vishwas, who's sort of, playing a role in the payments ecosystem with CC Avenues. We partner with the payments banks who issue currently debit and prepaid cards because they can't do credit cards, but they also now are expanding into acquiring BIN sponsorship. And you would sort of say, yeah, that's expected, but in some ways we have further opportunity to partner with Dilip and NPCI, because we have a payment gateway offering which processes transactions of all networks. So we would process a Visa transaction as much as a RuPay transaction or a Master or an Amex or whatever. So, partnerships is fundamental to everything digital. As Parag said, no one organization will have the stack to do everything at all points in time. And I just gave the example of every entity that is represented on this panel. We look to genuinely partner with them. I don't mean it just in a superficial sense. Yeah.
Thank you. Mr. Azbe, I'll come to you next on a bit of regulation only. So has the time for payments bank passed, as other instruments have really crowded the market, UPI, RuPay, e-rupee, CBDC, retail, you name it, it's a really crowded market. So do you think it's something that we should just move on from?
Sorry, I don't understand your question.
I'm asking, has the time for payments bank passed? Should we phase it out because, the market is so crowded that, we are looking at other models?
So, ma'am, Rishi and Ganesh, both are our customers. So, you want me to say against our customers?
No, I don't. No.
So, okay, that was on the lighter note. And see, ma'am, I think the regulator and the government, the way I see the evolution of the India payment system is having the choices, right? Because it's a 1.4 billion population nation, right? And the population is at various stage of evolution by themselves, right? So, for example, and I give this example multiple places, that maybe the top 200, 300 million Indians is like Western Europe. The next 300 million Indians is like somewhere like developing country, and the rest 300 millions are like trying to become developing, right? So that's the way I look at the country. And I think in this kind of a situation, the choice to the customer is very important, right? The second point which I want to make is, so while you could say UPI, IMPS, debit cards, credit cards, the IMP, NEFT, you take wallets, right? So I think all the payment choices, when we look at the digitization today in the country, in my assessment, we are not even 1/3, right? Pure digital form of transactions in India. Right? While the penetration might be on a 50% on value, large volume, which is still on cash, which are predominantly the small ticket transactions. So I think India is a high volume, low margin game, right? As far as the payments are concerned. And I think lot more action is still required to map that remaining 2/3. So I'm making a business case for you guys. So
Yes, absolutely.
so I'm just saying that everybody, all the stakeholders are very much necessary. Everybody has a role to play in my assessment, and the payments bank are actually looking at their niche to provide, whether it's UPI, APS cards, right? They have a segment and they are trying to service that. And while the small finance banks, the full function banks have their own segment. So looking at the country like this, I think I don't foresee an issue on the business model to the payments bank. So that's one question.
I think just to modify her question, I think what she really was not talking about the payments bank per se. I think she was talking about the old payment instruments versus the new payment instruments. I think that is what you must be referring to.
Yeah, I was saying that the universe has become so crowded now.
So crowded.
So crowded that, is it relevant to have payments bank?
No, of course it is. That's why I said, I think we still have 1/3 population and we still have to get 2/3 population covered. So I think the institutions are fairly relevant, and these institutions have a very large scale as well. Airtel comes backed by the Airtel telecom operator. So, Fino has been a very strong player in the financial inclusion right from last 15, 16 years, right? So in fact, we all learned financial inclusion from Fino, in that sense. So and RBI has really thoughtfully given the licenses to the entities which can actually make an impact in my assessment. But obviously, it's a long-term game, right? I don't think 2-year, 5-year, it may not serve the purpose because it's a journey and it might need a decade to really see a value out of this journey.
Ma'am is trying to promote payments bank need to move to the next level of regulation and make a more inclusive bank by becoming a digital bank or a small finance bank. Maybe that is what.
Yes, that is another possibility. So I'll move over to Mr. Patel. How do we change yesterday's regulations to make things more relevant? You have a tough task.
I think regulations is constantly evolving. Look, if you look at any kind of commerce, right? There is credit, there is debit, and there is cash, right? If you have seen the evolution of cash during Demon, it was 18 lakh crores. Today, around 31 lakh crores of cash is in the market. So that is also growing. Debit also, if you see what was with the advent of UPI, UPI has today cannibalized a check, it has cannibalized a demand draft, it has cannibalized pay order, it has cannibalized NEFT, RTGS, and any kind of ease of doing P2P payments. So UPI has cannibalized that entire other debit mechanisms that were there existing in the market, right? Credit also, if you see today the offtake, right? Today the offtake in credit, earlier, if you see on a macro perspective, the household debt today in India is 11% of the GDP. Now you compare to the markets like US, it is 84%. So this clearly states that there is a huge offtake of credit in the market. Now all these three things are going. Regulations is like something like the RBI will have to constantly evolve. It can't have one static because we have seen many of those notifications put earlier are continuously being amended on a monthly basis in some cases to keep up with the times and the change that is happening. So I think RBI is in a very consultative approach. We heard the governor in the morning, right? They are consultative. They are consulting the industry, and I think those are constantly evolving. So I think it will keep up with the pace, and you have seen the growth overall in payments and other things, right? So it will keep evolving.
Mr. Rao, you plan to double your card user base. So how does it really fit into the digital ecosystem?
So, like I said, we're a full suite bank. We're a full suite bank. We offer the entire range of payment forms. UPI, wallets, debit, credit, sorry, everything else. Okay, what I talked about was one business P&L, which you're talking about, where the opportunity is right. So, Dilip mentioned the top 300 million. Okay, maybe that's the first step of being the target for credit cards. We're a vastly underpenetrated market as far as credit is concerned. It's clear. It's very clear that India does require an expansion or democratization of credit in whichever form. Credit cards as a product form is one of the ways in which credit is used, and so therefore we have aggressive plans on that in that phase. But then let me also tell you that we have equally aggressive plans on many of the other payment forms, okay, because the idea or the objective which we have as a payments business within the larger full suite bank is to ensure that you and that's our objective, to sort of lay the railroads for carrying any form of interoperable institution, which is basically moving money from point A to point B, and issue instruments in whichever form the customer, the choice which Dilip talked about, whichever the choice the customer wants to. So that's our core role.
And the market is still, there's a huge distance to cover. I mean, you have roughly about 400 million people in the country on whom some form of credit data and history is captured. You have maybe 220, 250 million who are cardable. You have 80 million credit cards and hardly 40 million unique card holders. So that market can grow 4 to 5x, irrespective of what's happening. And I'm just talking consumer. Globally, there are some great examples in markets of B2B payments and commercial payments on card rails. Now, it doesn't have to be a plastic or a metal card. It's just card rails. So that's a huge opportunity, which is hugely under-leveraged in India. And there are lots of benefits of that as well. So I think the overall, everyone is agreeing. And at the end of the day, it's about giving consumers choices. And which is why we also believe that it's not about national versus international versus anything. It is actually open loop, interoperable systems, which give consumers choices, and they will pick and choose. And even the most, even in rural markets, even customers who don't have the benefit of a lot of, knowledge, they're pretty savvy. They figure out very quickly what works for them. And I think that's the best way for us to go as a market and as a country.
Let me add to that, follow through to what the thing is. I talked about one of the pillars of growth which we're going forward, which is market disruption or market expansion. Well, I'll sort of point out to the latest initiative which NPCI has launched out, which is you can link your RuPay credit card to your UPI account. Now, that the way, if you look at it democratically, I think has the opportunity to do the 3x, 4x, 5x on the credit card market, which we talked about, because you have people on the electronic rate rolls. They are used to now debit to account. These are the people who have a track record of electronic payments, and they need credit, or at least portion of them will need credit. And we've only created the rails in which credit can be easily accessed by these millions of customers. So the market expansion will definitely happen.
So related to that, I want to talk a bit on innovation. Mr. Anant Narayanan, your payments bank recently announced eKYC face recognition. So do you think business will look up after such moves?
Yeah, I personally think, and I spoke about it at the start, the reason why digital transactions have grown to such a large extent has been led largely by innovations. Of course, there's been a lot of consumer education and awareness being done, but the bedrock is really innovation. And I think as we go forward, and Airtel Payments Bank also firmly believes in that. For example, today, a customer in rural can actually use FaceAuth and open a bank account very, very seamlessly. And we have enabled it for all our 475,000 BC agents in rural. The retailer does not need a biometric device, and the customer can the retailer can use the smartphone, take a photograph, capture the credentials, and we are integrated seamlessly with the UIDI database, and the bank account gets opened. We are now also partnering or working with NPCI to get that same functionality done on AEPS-based cash withdrawals. So there are multiple such innovations which we believe once it sort of comes in, will really take up, dramatically improve experience, because you're seeing that the conversions on face auth is anywhere between 7 to 9% higher than a fingerprint based authentication, and that's our experience. So we believe that with more and more such innovations, there will be better adoption. A second innovation we brought in more than a year back was on the safety platform, where we launched a product called SafePay, which is very unique in the sense, maybe first in the country, maybe even the world, where we used the telecom network to actually authenticate the transaction to ensure that I am the one who's actually initiated the transaction and getting the transaction done. And it really helps do away with mule accounts and brings a third factor of authentication on the entire safety platform. And that's actually, we are now processing almost 250,000 transactions a day on SafePay. Which is a very, very important aspect. And it's also become amongst the top 3 key concerns for consumers after COVID. So it's a big problem we're solving. And you've seen that with a lot of these innovations coming in, consumers starting to trust the system, trust the process, and possibly using it more and more often.
So the union budget is just about a month away. Any wish list from the budget? That's for you, Mr. Anant Narayanan, and all of you, in fact, I want to ask.
Digital payment incentive would be one ask from our side. It has been there. Last year, government has been kind enough on last year. Even this budget, last year's budget continued that. So we are hoping that even this budget will have the digital payment incentive. That's very important for the ecosystem, because there has to be some incentivization for the ecosystem to provide the service, right? I'm saying nobody can run the platforms for free of cost. So I think one key ask is could be the digital payment incentive to the government to continue to the finance minister.
You've had your meeting with the finance minister, and have you submitted your?
Madam, I think everybody has been asking about that. So it's not only NPCI, PCI, banks, the fintechs, the merchant acquirers, everybody has been asking for the digital payment incentive. So it's not only NPCI in that sense.
Yes, so is there hope this time in the budget that, there will be major announcements in the fintech side, digital banking side?
See, obviously, I think the digital payment is at the forefront of this government, and we have seen the attention and focus, not now, but even starting from Jan Dhan Yojana till now. I believe there would be something, and in our assessment, incentives would be required to at least sustain the digital payments growth, what we have seen over the years.
Yes, Mr. Patel.
Right. From Payment Council of India on this digital incentive, I think 2 years back, there was, I think, provision made in the budget of 1,350 crores. I think last budget was 1,500 crores. Now, as PCI, we have asked for 6,000 crores for UPI and 2,000 crores as incentives for RuPay debit card, so that, the costs for the payment aggregators is somewhat revert. I don't think they will be reaching that, but I think even a 50% escalation from what currently they give. We have also asked that the way they are giving out these incentives, right? One was always that don't call it incentive, call it a subsidy, because incentive attracts GST. So it's like God give it and God take it away.
No, but government has issued the notification today that it is exempted from GST.
Today?
I'll send you that.
Okay, super. So I was not aware. So that is there. Second part, we have also asked the government that we want to increase the acceptance base, right? So the real incentive, if we are doing at 0 MDR, because this is actually government paying for the merchants acquiring of UPI. So today, say if 1,300 or 1,500 crores is what government is paying, it's paying for all the UPI transactions. We've said that if government is using the taxpayers' money, it should be this subvention, this incentive or subvention should be only for the smaller or the medium merchants, because we want to actually increase the base. Because if you see 2,65,000 crores of money of cash is withdrawal from the ATMs, and then these salaried guys withdraw it and then use it to pay to the Kirana guy or wherever that is there. We need to reduce this. So if we increase the acceptance base, right? So it's a small merchants. If this more money is spent on those, like today, say, out of this 1,300 or 1,500 crores, majority or 60-70% is taken off by the processing UPI on Amazons and Flipkarts. Now these guys, for the other alternative mechanism like a Visa debit card or a MasterCard debit card or any other things, they are anyway paying a MDR. So for UPI on this, if it is given only for the smaller merchants, it will go a long way in increasing that. That's one part, of course, apart from the taxation that is there. And also, as Parag ji also said in the start, that tax avoidance, like if you've seen to grow the acceptance base, some kind of a tax incentive for smaller to medium merchants for accepting electronic payments will go a long way in increasing the base. Because I'm also part of the Payment Infrastructure Development Fund created by RBI. We are trying so massively to grow the acceptance base. So if these kind of tax incentive will go a long way for the smaller merchants if they start accept. It's there in Sweden that so many, South Korea, so many cases where tax incentives are given and the acceptance base has gone through the roof.
Thank you. That's a nice long wish list. So we cannot not talk about cryptocurrency as we wrap up this session. Mr. Ghosh, what's your thought? Should it be banned, allowed, or should it be kept in this no man's land?
I don't think I'm the right person to talk about that, quite honestly. I think every country decides in terms of what they're going to permit in terms of regulations, and both the Indian government and the Indian regulator have been very clear about their stand on crypto. And therefore, I mean, when we operate in different markets, we are first and foremost governed by the rules and regulations of that market. There are various things that are happening globally around, crypto wallets and things like that. There are use cases that people are still working on, but clearly in India, this is not something which is, favorable. And whilst we, as an international company, might support some of this in jurisdictions where it is permitted, as far as India is concerned, right now it's off the table.
So we can take a couple of questions from the audience. Is there anyone wanting to ask? So Vinu will give the mic.
Good evening, everyone. I'm Naveen from Hyperverge. Thanks for giving this opportunity. My question is to Dilip sir. We are talking about payments exploding through UPI, payments exploding to other modes of instruments. But I would like to hear about what's our vision to make transactions more secure. Right? Today we have UPI-based PIN. But is there any other alternative method that we are exploring to make transactions more secure?
Mr. Rasbe.
So, see, it's a great question. See, today we have, we are all the networks, banks have to operate in the two-factor authentication mechanism, which is again, thanks to RBI, it's first of its kind in the world. And now many countries we see that adopting the two-factor authentication policy, which RBI formulated about 10 years back. So all the efforts, initiatives are two-factor authentication. Now, what is the experimentation going on? Obviously, you would have seen Aadhaar, AEPS, which we came up with the biometric authentication along with UIDI, helping acting as an authentication agency on behalf of banks. We are also looking at some of the other behavioral analytics and those kind of things to see what can be done. But as on date, the what you have and what you know, right, which is the standard two-factor authentication policy which you apply, the device or the card what you have, and and the PIN is what you know, right? So that even if your device is lost, your money in the bank is. In fact, some of the UPI apps over and above that, the what you call the app passcode as well. So it's actually not two-factor authentication; it's a three-factor of authentication. But I think it's an interesting area for all of us to work on, and maybe there is some more progress to be made to really come to the level of launching some of the new authentication methods to the ecosystem. But as far as the low ticket is concerned, now RBI has permitted the cards on which the EMV cards on a tap and pay model, which again all the three networks are very bullish about, and the amount limit is also very high. And also we have launched the UPI Lite now, which is up to 200 rupees. Now the device authentication. So how do we ensure that the value of the transaction actually and the risk associated with that transaction, and what is the balance between the risk versus the convenience, as some of the panel members were talking about? How can it be struck? So we are constantly evaluating, and thanks to RBI, they are also open to such ideas that how can we really how can we strike that balance very effectively without causing any risk to the ecosystem? Thank you.
I can maybe chip in on a couple of things. So one is, you also saw the move by RBI to implement tokenization. Part of that is also about security, because now no one other than a issuing bank or a network can actually store card details. There have been a lot of compromises of card details globally, which have happened when a merchant's ecosystem got hacked, etc. Now, tokenization has not only introduced an added element of security, but we are seeing better payment success rate of cards that are tokenized. So it's actually had an additional benefit. And look, at the end of the day, one of the other things about security is you can have many factors of authentication, but if a customer actually gives away their PIN or their OTP, then even 10 levels of authentication is not going to help. So education, literacy is a very, very key thing which all of us in the ecosystem have to also work on, because you just can't keep building safeguards, because each of these safeguards actually creates friction. And the card controls and all have also created friction. When people's cards don't work, they say, what's going on? It's because you've got specific card controls which you have to unlock explicitly. So we've got to get that balance right. That's what I was saying earlier. But yeah, it's a focus of everyone sitting on the panel here.
Yeah, Mr. Rao. Yeah.
Let me add to that. So, and I think I must start off with this. I think the focus on security by the regulator is not just now, but I think it's been there for the last 10, 15 years. We talked about second factor authentication, which we all as consumers use, but you should know that there are even things like what we call TLE, terminal line encryption. All your POS machines are so completely guarded, it's unhackable practically. So those are also the conventional means in which we got probably one of the safest systems. Okay, coming to apps, which are the most vulnerable, you now have most banks and most people actually, deploying wrappers, if you may call so, which stop your mobile or some fraudster to be able to force download a fake app onto your this thing, which sort of scrapes your thing. So these are all the kind of other initiatives which you do. Today, most of the frauds which you see, a lot of the frauds which you see, and it's increasing trend, is what you call phishing and wishing, when you fall prey and trap to so-called fake SMSs or fake calls, etc. That, to my mind, is today's current sort of kid on the block, which I think as an industry, I think we need to sort of take cognizance of and really move on. And in my view, I think this actually requires a lot of collaboration between not just the banking and financial sector, but also even the telcos, because those are the carriers of this thing. But I think, let me assure you on behalf of everyone here that not just the regulator, but all the industry players have probably risk as if not number one, number two priority in terms of the infrastructure which we're sort of laying down to ensure that the payment ecosystem is safe.
I just want to add one more point to what I think Sandeep mentioned, on customer awareness. One of the things which I think a lot of us have, Airtel Payments Bank definitely is doing, is to also use AI/ML to understand amongst the 55 million monthly transacting users we have, who are the customers who are likely to be, in the vulnerable area, and possibly sort of dealing with them separately as compared to possibly all of us who we believe, we are in control, we know what's happening and so on and so forth. So use of AI/ML is also a very important aspect in actually bringing down frauds and putting in more controls in the space. That's another
Any other question?
Hello, am I audible? Yes, so my question is specifically to Mr. Rishi Gupta and Mr. Ganesh A for the payments bank industry. So with the 75% SLR and the 20 and the 2 lakh deposit limit, the payments bank, let's be honest about it, is not the best business model provided by the RBI to us. And I think Mr. Rishi Gupta was very vocal about the fact that we will, and RBI gave them a side door exit to convert to an SFB very soon, like within 5 years instead of 10 years. So how important will it be for, and Mr. Rishi was also very vocal, that we will convert to SFB as soon as possible. So how important is it for the payments banks like Airtel, Fino, Jio, NSDL, everyone to convert to an SFB and pivot the model completely? Thank you.
So, yeah. So, without getting into real specifics about Fino or any particular bank, I think the way the model has evolved, the fact that within the constraints in which the regulation is, there are constraints in terms of the amounts, constraints where you can deploy the money, constraints on third-party approvals which are there. I would say the payments bank have done fairly well from the time we started our journey to the time where we are currently. Can the model become better? Obviously, the model can become better. As Ganesh also said, and I also said initially, the fact that we have the rails going to the last mile in the country. So can we leverage it better? We can definitely leverage it better. What is stopping us from doing it is the license or the regulation which is there. So if RBI permits for us to get into credit or move or convert a payments bank or convert all payments bank into digital bank or give an option to a few of them to convert from a payments bank to SFB, I think we can use the infrastructure better. We can obviously service the customer better. And when the customer is coming to us on liabilities and transactions and the data which we are building, we can use the same for credit. I think for a business model per se, it will be a good conversation. From a customer point of view also, it will be a good conversation. So we will have to see how the regulation evolves from here. Could be a digital bank, could be a SFB. We'll have to wait and see how the regulation looks at it, or the regulator looks at it.
I just want to add to what Rishi mentioned. See, for us, and that's true for most all payments bank, there are three sources of revenue. One is, of course, what you mentioned, which is revenue from customer balances. Second is transaction income, and third is fee income, which is revenue from cross-selling and upselling financial services and so on. It's important to look at the revenue construct as a sum total of all three, rather than judging a payments bank on its ability to make money from customer deposits. That to us is possibly 10% of revenue. 90% of revenue actually comes from the remaining two. And given the fact that we have 50 million plus monthly transacting users coming in, even a 3% penetration of insurance on that has the potential to actually double or triple or quadruple, our revenues. So the opportunity, with the existing ecosystem is very significant. Of course, as Rishi mentioned, if some of these things do happen in terms of allowing small ticket lending, I do believe that it can do a world of good to driving financial inclusion, and it can, of course, accelerate, profitable revenue growth for all payments banks. That's what I would say.
Last question.
Hi. Thanks a lot. My name is Bhanu Pratap Singh, and I represent a company called Tubulight Communication as the CEO and Director of Engineering. Is it audible? All right. My question is around in the context of the evolution that we see today, especially in last decade, everything seems to be on the hyper speed. Of course, technology evaluation, customer side expectation evaluation, financial evaluation. We are not anymore competing bank versus bank. So how you see open banking in that context?
You an open bank, Parag? He's asking.
Yeah, absolutely. Well, the way open banking has different meanings depending on who asks that question. The way we look at open banking is about significantly enhanced availability of products and services available at many more touch points than they are today, okay, in a seamless manner, safe and secure manner. Okay, what does that mean? It means that today, conventionally, if you can access a product or a service walking into a branch or through a telecalling or on the net or mobile, can those products be available at many more touch points which you touch during the course of your normal life? Whether it's at a merchant, whether it is embedded finance when you're purchasing X product, is it bundled along with another product seamlessly, etc. And that, to my mind, is open banking. As an outcome of that, and so one way of looking at open banking, it's an enhanced distribution game. What you need to do to ensure that get that kind of level of distribution, you're talking of therefore having a network, a digital network which is safe and secure, number one. Two is you need to therefore also tackle issues like whom are the partners you could, because there's no one entity which can do it all. How many people do you need to partner? Whom do you need to partner? There are now rules and regulations about sharing of data. Okay, typically that's one of the interpretations of open banking. Is it only about sharing data? I don't see that as that way. In the process of partnership and having a relationship between a principal and a distribution partner, whomsoever it may be, there is a safe and secure way of sharing data. Ultimately, the idea is to ensure that products and services are made available in a simple, seamless manner, transparent manner, and in a safe and secure manner. And today's technology enables a lot of that, whether it's embedded APIs, headless APIs, whether it is using surrogate data, using substitute data to ensure that customers can access. So that's my definition of open banking. And I think and we are doing a lot of work in that to sort of leverage our large distribution channel to be able to do that. Let me give you a very crude form just to tell you. So BC network, what is that? You can choose to call it a DSA for liabilities, but the BC network is one example of how banks or institutions have actually expanded, and that to my mind is open banking, because they are now represented. There are lakhs and lakhs of representatives of banks in the hinterland, which has actually created a significant amount of penetration into the rural areas. Okay, so that's my definition of open banking, and I do believe that each one of us on this panel and our own colleagues outside in the industry are working in some form or the other in terms of pushing this open banking envelope.
Thank you. With that, we've completely run out of time, and thank you so much, everyone, for sharing your thoughts. Thank you so much.
Payments Bank. Mr. Dilip as